over $1 billion. Rising stock markets last year helped fuel those donations. And Disney is dropping a mask mandate for fully vaccinated guests to its theme parks in the US. Face coverings will become optional for inoculated visitors in both outdoor and indoor locations. Starting from tomorrow, Disney World's website cited recent trends and regulatory guidance for that shift. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
As the company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Concerning whether we want it or not, of course. course not. That's why we put forward proposals about the negotiation process. We didn't receive a substantial constructive response on proposals made by us.
The President of Russia, Vladimir Putin, with his German counterpart in the last 24 hours, Chancellor Olaf Scholz. From New York City with Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. It's the price action, down not even a tenth on the S&P. We're down 3 points, negative 0.06% on the NASDAQ, just about in positive territory. Yields come in a single basis point, still north of 2%. Crude comes in 1.23% to 93.20. Retail sales just around the corner, 1 hour and 42 minutes away. I know you focus on the control group for retail sales, Tom. The input into GDP, just looking at that number, 1.2% is the estimate for January after a softer than expected month of December.
I'll be honest. Years ago, did I pay attention to retail sales? Yeah, you do. The consumer is 69, 70% of the economy, John. But now we really pay attention to it. It's important.
Are we going to get some pushback, TK, some bigger pushback? You've seen what's happened with the consumer confidence numbers. You saw what the Heineken CEO said to us in a telephone interview. Do you start to get more pushback as prices go higher?
We're going to have to see in this hour where we look at China. Bill Lee, early in his note with Milken, made real clear the growth vector into the middle of the year and end of year is going to be critical. Right now, we continue on China. Enda Curran with us out of Hong Kong with Bloomberg News. It's been way too long, Enda, since we caught up with you. I looked at James Burns Murdoch's great work in the FT on logarithmic per capita cases and deaths. It is shocking how good the news is in Hong Kong and, frankly, in China. There's some issues about accountability, etc., but it's stunning how well they're doing. Why all the angst in Hong Kong and China over cases, hospitalizations, and deaths?
So there are a couple of things there, Tom. First of all, we are now at the beginning of a major outbreak that does look to be exponential. And we do have a good proportion of the over 80-year-olds in our population who are under-vaccinated. They are quite vulnerable. The government has been warning about that. And of course, they've just started vaccinating the youngest age groups as well. So there are concerns over those vulnerable to this disease who could fall to it. Secondly, the hospitals are being overwhelmed. That's not because everybody needs to go to hospital, but the policy here is that, if you're infected, there's a good chance that the government will send you to hospital. Now, at the moment, they are allowing some asymptomatic patients, or if you have mild symptoms, you're being allowed to stay at home. But nonetheless, the dragnet is sending a lot of people to the hospitals. Now, yes, the overall caseload in Hong Kong relative to other major financial cities is, of course, low, but we're just starting this now. And when you listen to the scientists, they're talking about an exponential growth rate. China has it under control for now, for the moment as well, but of course, they're worried it will leak in across the border into Shenzhen.
A delicate question. Is Hong Kong just another Chinese city now?
Well, look, all the indications are, Tom, that the central government is increasingly putting its stamp on the running of Hong Kong. The degree of autonomy that it had is certainly being eroded. We know the backstory about the erosion of freedom of expression, civil liberties, the crackdown on the pro-democracy movement, etc. But now we are seeing it, of course, increasingly on the administrative side of things. And with this virus outbreak, the central government has intervened forcefully. President Xi Jinping out today in the state press in Hong Kong, making it clear Hong Kong has to do whatever is necessary to get this under control. There are vaccines coming from China. There are testing personnel coming from China. There's other help coming from the mainland. So absolutely, China is in the center of the operation of Hong Kong now. There are still distinctive features here, but of course it's increasingly being folded into the mainland itself.
To put a point on that, and does Carrie Lam's job depend on her willingness to actually engage with the lockdown that Xi Jinping is requesting?
Well, that appointment will come up next month, Lisa. We don't yet know if the Chief Executive, Carrie Lam, does want to put her hand up for it again, but there is no doubt that this outbreak is coming at a fairly critical time for the government. Remember, from their perspective of COVID-0, which is what the Chinese policy is, they obviously had been doing quite well up until Christmas time, but January, of course, has seen that shattered, and not only has it been shattered, there's no real sense that they have it under control. So when you see that intervention from Xi Jinping, it underscores how nervous the mainland or the central government is that this leaks into China. And by extension, then, you would have to say there is a lot of pressure on the Hong Kong authorities to get this right.
And in the meantime, we got economic data overnight showing that inflation actually slowed more than expected in China, leading to this speculation that the PBOC would have a greater ability to loosen up policy and possibly cut rates further. What's your sense of how the PBOC is planning to manage all of this, given the fact that they have been trying to deleverage, and yet it seems like they're being rewarded for going in the opposite direction?
Well, they have a window now, Lisa. Consumer prices came in just below 1%. That's because food prices are falling and China isn't seeing the energy surge that other parts of the world are seeing. Producer prices also coming down. That's because prices for commodities are coming off the boil. So absolutely, there is not an inflation problem for the Chinese authorities. That does give them a window to support the economy. We know the consumer is subdued. We know the real estate sector is under pressure. Manufacturing is expected to slow down this year, so they have a window. The question is, though, how long will that window last? If the Fed goes off on an aggressive tightening cycle later this year, what will that mean for China's currency? What will it mean for money going into and out of China? Will it suck investor capital away from it? So I think a lot of economists would say there is a window for them to move now, the PBOC, and they're expected to do so again, be it through the money markets or cutting interest rates. But maybe the second half of the year, that might get a bit more complicated if that divergence between the Fed and the PBOC is deepening.
And you're one of the best. It's awesome to catch up with you. And Karen there out of Hong Kong. Just on the issues at the moment, Tom, the cross currents, it's such a different picture in China versus the United States. The US ready to tighten, to raise interest rates. Inflation's too high. China with a different story.
It's a different story, John, but you know, I've said this before, and I think Jay Pulaski, one of your guests on one of your other properties, really has led the way on this. Betting against the Pacific Rim, and I'm not talking politics, folks, I'm talking business energy, if you will, trade energy. Betting against the Pacific Rim is hazardous to your pocketbook.
Well, let's think about what's at the epicenter of, say, Jay Pulaski's call right now, Tom. Global synchronized growth for 2022 didn't happen in 21. He thinks it will happen this year. You need to see some real reopening take place in China. And Tom, given the conversation we've just had in the last 20 minutes, we're not exactly talking about that, are we? We're talking about dynamic, zero COVID, whatever it is at the moment in Hong Kong and on the mainland.
I guess it's a delayed Omicron, you know, and time will march on and they'll figure it out in their own way. The statistics are refutable. I'm not sure I trust the statistics, John, but, you know, they're what they are.
Tom Keene, Lisa Brammitz and Jonathan Ferro. Futures are down a tenth on the S&P. We're down a little more than 0.04% on the NASDAQ or something like that. Yeah, not much good drama out there.
It's a Wednesday data.
Yields come down about a basis point, Tom, like to 2.03. What was that, Lisa? Go to cash.
I was trying to do it.
You can do it again. Go on, you've got some time.
Okay.
No, go on.
Go to cash.
Is that what it sounds like?
I don't know.
Is that? Go on, Tom. Do go to cash.
I can't go to cash. I'm already in cash.
Well done.
Triple leveraged, all cash.
93.37, all cash,
like
down
1.4%.
Cash. Coming up, I'm going to tell you why this show is going to Belgium very soon.
We are?
We're moving to Belgium.
That's so cool.
I will tell you why in 10 minutes' time, when the break's over, okay? From New York, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Okay, traders, as you can see, position closed on British pound. We closed, we made profit, 700 pounds. Well done, guys. We hold it overnight. It's worth it to hold overnight. If you want to get the strategy, please go to company.co.uk. You can get the strategy. Also, you can get a webinar if you want to speak to me. If you want to talk about the strategy, please send an email or register for webinar. Okay, places are limited, so first come, first served. And let's move on. Let's see what other opportunity will give us today. What day today? 16th of February. And I'll speak to you later. Stay safe.
Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. Futures aren't doing much. We're down a tenth on the S&P. TK, did you see the news? Belgium giving workers the option of a 4-day work week. Still got to work your hours, but you do it over 4 instead of 5, and you can turn off your so-called work devices after work.
Well, we do that anyway.
Without fear of reprisal. And ignore messages from work. Doesn't that sound brilliant?
Yeah, I like it. I mean, I think it can be a format we can work with. I think Maria Tadeo is like ace on this.
We'll take the show to Brussels.
Yeah.
I imagine she gets relocated pretty quickly, Tom, when she starts to what, for 4 days.
She's going to go right over the border. She'll go to, what is it, Luxembourg's right next to Belgium. And
get to Germany, Lisa. Get to Germany.
Honestly, you guys are just endearing yourself with everybody here, whether it's Taylor Riggs, whether it's Maria
Wouldn't it be great if you moved the markets from a 5-day week to a 4-day week? I mean, we'd have a 4-day. That would be great.
It would be great. I think a lot of people would like it, but then you'd have the people who work the 5th day.
And the people in crypto, I just don't know. The world the crypto people have set up is just too much for me. Tom, this market unchanged on the S&P, unchanged on the NASDAQ. The data a little bit later this morning, 90 minutes away.
Waiting for news. There's been a real dearth of headlines here out of Ukraine today. That was certainly the mover yesterday. We don't have Scholz and Putin, as we saw yesterday. John, I thought that press conference was extraordinary. But what we do have, John, is a follow-on to the United Kingdom stunner of higher inflation. And that is, if you have higher inflation, will people buy things? Retail sales coming up, important.
Tom, the data out of the UK, north of 5%. On CPI. The Bank of England meets on March 17th, the Federal Reserve on March 16th. Tom, we're having a conversation now about a 50 basis point hike maybe in the UK, a 50 basis point hike maybe in the United States as well. This is a tightening cycle like we haven't seen before, and it hasn't even started yet.
We've got a lot of people, and of course we'll address this in the hour here as well, folks, saying you've got to wait, because about April time, I'm just using it as a guesstimate, John, you're going to start to see certain things roll over. What is the agony if they move up too quickly all central bankers really want to avoid that.
And we're going to have to start talking about a pause really, really quickly. Tom, we have to touch on what's happening on the geopolitical front as well. We've had the communication out of Russia. We've had the headlines that suggest they're pulling back from Russia. And then we've had the headlines as well from the US president. The NATO Secretary General says it sounds good. We'd like to see it.
Yeah, well, we got headlines out at 7, but they're financial headlines as life goes on as well. Certainly, that was the tone of Mr. Putin yesterday, talking about the relationship of hydrocarbons with all of Europe, and particularly with Germany. But, John, it's flat out, we just wait for headlines. And I also would suggest we wait for an interpretation of U.S. intelligence on the moment in Ukraine.
Let's get to Mandy Zhu, Tom, the Chief Equity Derivative Strategist at Credit Suisse. Mandy, should I be pricing in rate hikes or the cuts that might be in our future?
Both. So what's interesting is even as traders are pricing in more aggressive rate hikes for this year, currently just under 7 total hikes being priced for the year, they're also pricing in rate cuts further out. So starting in 2024, the curve is actually inverted with about 70% probability being priced in currently that the Fed will have to cut rates very soon. Right, and what that tells you is that there's a real risk that the Fed is about to embark on a policy mistake, meaning over tightening now and killing off economic growth and having to cut rates very, very quickly soon after.
Mandy, there are 4 cross moments here that pros like you follow, and one of them is this odd thing called SKU. We don't do SKU, we don't do derivative math on Wednesdays. But what we can say, Mandy, is it has to do with the fear that's out there. And when you are feared, folks, in global Wall Street, you hedge. What is the demand now, the appetite to hedge?
So interestingly, to start the year, we haven't actually seen much significant increase in demand for hedges up until I would say over the past week. And that's interesting because, obviously we had a 10% pullback in the S&P in January, and actually volatility really underperformed on that sell-off because of this lack of hedges. And I would say part of that reason is because, you think of the catalyst driving that correction, it was, fear of higher rates. And that's really a well-anticipated catalyst. It's not really an unknown or uncertain, unexpected risk. What we're seeing over the past couple of days is more demand for hedges on the back of the Russia-Ukraine news, and also on the back of a speculation that the Fed may be hiking intermeeting. I think that has driven a lot more hedging activity in recent days.
What is the leverage exposure wrapped around the hedges and, frankly, the entire market? I mean, frankly, folks, Credit Suisse literally invented the monitoring of leverage, I would suggest. What is the depth of leverage out there?
So I think for a lot of institutional investors, they have deleveraged quite a bit. Especially January was very painful for a lot of hedge funds. And this is, I would say, the most pronounced at the sector level for tech. In terms of kind of the protection buying that we're seeing, they're not crash protection buying. Typically, the protection buying that we are seeing is positioning for a more modest pullback from here. So I would say, given what happened in January, given the deleveraging that we have already seen, the protection buying that we're seeing right now, it's more modest. It's not as bearish as some might think.
Mandy, a lot of people will think of me as the person who comes up with a negative scenario no matter what happens. But there is that kind of baked into the hedges, too. There are the people who are hedging for a Fed policy error on both sides, not only moving too fast, but not moving quickly enough at a time when inflation itself is crimping demand, or there is the fear of that. Perhaps we'll see some of that in the retail sales at 8:30. What's your view on why people are hedging and how you could determine this from the type of hedge?
Sure. So I would say, on the risk of the Fed being behind the curve, I would say that's a risk that is, I think, overblown because, yes, we're seeing very high inflation right now. But the important thing to emphasize is that long-term inflation expectations, whether or not you're looking at, market-based expectations, looking, for example, at the 5-year forward break even, or you're looking at consumer surveys, they remain remarkably well anchored. And as long as that, remains the case, I do think the Fed has more breathing room. But in terms of, what people are hedging, I would say looking at, hedges in tech has been very popular. And then the second one that has been more popular right now is looking at cross-asset hedges, given, some of the moves in equities that we have seen, people looking across other asset classes, for example, fixed income ETFs, precious metals like gold, for example, that's been another popular one.
Mandy, have you seen a lot of investors decide to shift around their allocations with hedges hedges with derivatives rather than actually selling some of those holdings. And I think about tech stocks. For a long time, people were worried about getting rid of them for fear of not being able to buy them back at an appropriate price later.
Yeah, I don't think that fear is that as dominant this time regarding tech. But in terms of kind of how people are hedging and what they're doing, particularly I would say on the risk of inflation, it's very notable that what we've seen is in high inflation regimes, the correlation between equities and bonds break down, right? That's an empirical fact. And that's obviously, not good if you're a multi-asset portfolio, say a 60-40 traditional fixed income equity portfolio, because, your bonds are no longer diversifying your equity risk. So what we have seen from a lot of institutional investors is look at more equity specific hedges, so less reliance on fixed income to be your hedge. And the second thing is looking at commodities, right? Adding a commodities allocation, because obviously commodities is a big driver of the current inflation that we're seeing and historically always been that case. So looking at either adding allocation to the underlying commodity or increasing upside exposure to some of the commodity sensitive sectors, for example, energy.
Mandy Zhu, great to catch up. Thank you, of Credit Suisse. Thank you very much. The data, 8:30 Eastern Time, US retail sales, then on to this afternoon with the Federal Reserve minutes from the last meeting. And as we know, Lisa, you think you've gauged the Federal Reserve meeting and then you get the minutes and it gives a platform to a different set of voices. What was interesting about the minutes that we got last time around is the Fed minutes, for me, largely repeated what we already heard in the news conference, but we traded on them in a very, very different way.
Okay, so today I think that the focus very much is on the balance sheet. We haven't heard a real sense of what they're going to do, how quickly they're going to roll it down, and any commentary on that has a serious ability to move markets. And people are watching this as you have Esther George and other Fed officials saying that they want to steepen the yield curve, or they might look at the balance sheet as a way to steepen the curve and allow longer-term yields to rise a little bit more. How much could that disrupt markets with yields already at the highest levels going back to 2019?
Who's it a platform for, Tom? President Daley, President Bullard, take your pick.
They're all out there talking, and John, you know how I feel on this. There's over communication. The minutes, I get some translation. There's some, several, a few, and the rest of it, but there's just too much over communication.
Well, let's clarify this.
I'll say this. I said this yesterday, John. The chairman's got to step in and take control.
Exactly. Let's clarify this. Is there over communication, or do you just not like who you're hearing from at the moment? Because there is a difference.
No. I think the chairman's got to come in and take control. I mean, that's what Greenspan did.
You'd like to see a scheduled speech?
Yes,
before the next
I'd like
meeting.
to see clarity. I think there's always an advantage for a chairman or vice chairman with clarity. The vice chairman now is an issue, but I just, the blur that Michael McKee has to analyze is ridiculous.
Well, the issue, and you mentioned it, the vice chair position, at the moment, Lisa, Vice Chair clarity is gone.
Yeah.
We don't really have one.
And it doesn't look like we're going to get one. I just want to point out, I feel like this is a relationship issue, that Tom is saying he doesn't like over communication, just sort of give the doctrine.
You think this carries out over to his personal life?
I think that it's a very different style of socio-analogy and interaction.
I think what Tom's actually getting at here, and Tom's not going to say it.
He's not saying anything.
The over-communication is coming from just a handful of individuals.
Right.
What we'd like to hear from is from the core of the Fed. If President Dudley's going out there saying, yes, maybe, perhaps 50 basis points, but I'll let the chairman lead us, then let's hear from the chairman. Let's hear from the Fed chair. And
they don't even know.
Pretty quiet right now. I mean, Lisa, if they don't know what they're going to do on March 16th right now, don't you think they should know what they're going to do on March 16th right now?
I don't know. I actually don't know. I think it's a very tricky time right now with the data and with the movement in markets.
Should I send a dozen roses to Chairman Powell? Will that work?
I'm sure that would work.
Thank you.
I think that would cheer him up. Tom Keene, Lisa Bravitz and Jonathan Ferro. Futures down 0.1% from New York City. On TV and radio, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Russia has announced that more troops are returning to their bases after maneuvers ended in Crimea, but Western officials remain cautious. NATO Secretary General Jens Stoltenberg said there's no proof of de-escalation on Russia's part, and the Kremlin hasn't announced pullbacks of large numbers of troops along the Ukrainian border. Moscow has rejected warnings that it is planning to invade Ukraine. In the UK, inflation unexpectedly accelerated for the 4th month in a row. That's a surprise that adds pressure on the Bank of England for a supersized interest rate increase next month. Annual price growth in January rose to 5.5%. That is a new 30-year high. And it's a standoff in the Senate Banking Committee. Republicans on the panel blocked votes on President Biden's 5 picks for the Federal Reserve. The dispute has to do with only one of the nominees, though. That's Sarah Bloom Raskin. She's the nominee for Vice Chair for Supervision. Republicans say she hasn't adequately addressed questions about her role as a board member of a fintech company. Senate Banking Chair Sherrod Brown says he'll reschedule the votes. And Chinese viewers are flocking to the Beijing Winter Olympics in huge numbers. That's even as the rest of the world tunes out. The International Olympic Committee estimates about 600 million people, that's around half the Chinese population, have seen the Olympics on TV. Meanwhile, in the US, NBC may end up with the least watched Olympics in the event's history. Viewership is nearly half of what it was 4 years ago. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Earnings season continues.
To the Metaverse, to Spotify, to Qualcomm and beyond.
They're sinking big time.
You can't do better.
Bloomberg breaks the numbers first.
PepsiCo has given a sales outlook that beat estimates.
It's Peloton.
Disney and Uber.
Pfizer also out with earnings.
An expert analysis you won't get anywhere else.
This is fascinating.
What is going wrong for Meta that is going right for Twitter?
How much runway is left? Peloton really becoming a proxy for this pandemic.
I think there's tremendous opportunity.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
So far, we have not seen any de-escalation on the ground. On the contrary, it appears that Russia continues the military buildup. We are ready to sit down and discuss with them, but at the same time, we are prepared for the worst.
That was Jens Stoltenberg, the NATO Secretary General. Team coverage coming right up. I tell you what, if you could hear the commercial break, Tadeo, AMH, Tom Keane trying to speak French for about 2 minutes. Nice word, Tom. Tom Keane. Lisa Abramowitz and Jonathan Ferro. Futures are down a tenth on the S&P. Can you imagine how much an advertiser would pay for that, Lisa?
Yeah, actually, that was... And how much we'd pay not to let that go out.
2.0347% on 10. Yields in about a basis point. Crude, Tom, 93.21. Over to you.
Montaigne, a show. Okay, well, enough with the French. We'll leave it there right now. Anne-Marie Horton with us in Washington and Maria Tadeo in Brussels. And very symbolically, Maria Tadeo today at the NATO headquarters, placed on the airfields of Belgium of World War I and World War II when Germany occupied them. That is the backstory, Maria Tadeo, to all the emotions of NATO and the Minsk conundrum and the rest of it as well. What headlines are you looking for today in what has so far been a quiet Wednesday?
Yes, and Tom, really the focus in NATO today, and I should say defense ministers from all the NATO countries are meeting behind this podium that you see behind me, and what they say is that they want to see real proof that Russia is pulling back the troops. They say that Russia has done this many times. This could be misinformation. I had one official from Estonia telling me I would never believe a video that was filmed, recorded, and released by the Russians. I want to see our intel confirm that they're pulling back the troops. The other thing that they pointed, and this is perhaps at times a technicalities of war, but they did say it's one thing to pull back the men, but you have to pull back the equipment too. Right. If you leave the tanks and you leave the equipment, that means that in 2 weeks' time we could go back to square one. So they really want to see the proof today here.
Explain the NATO analysis of the fragilities of the Black Sea and to the north, the Sea of Azov. How does NATO feel that part of this study and intelligence is going?
Well, Tom, for starters, by the way, we're now seeing Romania joining in this NATO alliance. So you are seeing NATO, in fact, in many ways, expanding in the east and this real buildup, not just in the Black Sea, but also in particularly in the Baltics that are close to Russia. In terms of what this Black Sea conversation is, I would say the focus is not so much on the Black Sea at this point, but it really is in Donbass, in eastern Ukraine. Many continue to say Minsk is the only way forward. We want to see a diplomatic way out of this, and we believe that Russia is acting in good faith and is pulling back the troops. Then we have to go back to the Normandy 4 format and the Minsk agreement. But as you know, Tom, this is incredibly problematic because the way the Ukrainians look at the Minsk agreement is not how the Russians see it, and how the Russians interpret the Minsk agreement is something that the current government in Ukraine simply cannot accept.
And Marie, we've been talking a lot about how oil plays into this entire equation, with yesterday President Biden coming out and saying Nord Stream 2 will not happen if Russia does invade Ukraine. Do we have more of a direct sense of what the German position on this is, given the fact that they've been a little less vocal about it?
Yeah, I think in public they've been a little bit more aloof or elusive in terms of what they would do with Nord Stream 2, this private enterprise project that also Germany needs. And also the SPD, the party in which Olaf Scholz represents, totally supports more integration and communication and business ties with Russia. But behind closed doors, when Olaf Scholz was in Washington, he met with senators, and Senator Mitch McConnell had come out and said that the dinner was very well and basically had assurances that Nord Stream 2 would be off the chopping block. President Putin spoke about that energy dependence yesterday, standing alongside Olaf Scholz, and he made a point to say the economic ties between Russia and Germany are an intensive point at the moment.
Maria, how much of a signal do you get from the fact that we hear about all of the tensions from the U.S. government, from France, from Germany, not from Ukraine that much, that actually on the ground, the noise has been that people are not that worried about Russia invading them? What do you make of that?
Yeah, and Lisa, today we should note that it's a public holiday in Ukraine, and it's what they call the National Unity Day. A lot of this was done by President Zelensky to rally the Ukrainian people, and we should note that this is a very real life and death scenario for many of them, and that this is a country that for weeks has been terrorized on a daily basis about this attack happening. Now, the Ukrainians say we should not panic, otherwise this can turn into real social chaos. We want to avoid that. We see the economic damage already happening. We see the rich oligarchs from Ukraine flying out of the country on a private jet, and all of this is happening, of course, at a time where the people of Ukraine are very concerned but trying to stay calm. When you speak to European officials, they do say that perhaps it is a good idea to tone down the language, especially coming out from the U.S., which makes it, again, very uncertain and makes it almost way too panicky here for the Europeans. The French are saying we're not pulling anyone out. We don't see the situation escalating. And by the way, the troops have been stationed there for months. So technically on the ground, nothing has actually changed.
Maria, on a lighter note, a personal one, you're based in Brussels. Are you negotiating a 4-day work week?
Can I?
Maria. She's speechless.
I think team surveillance doesn't take 4 out of 5.
There we
it's
go.
full-time 5.
It's 5 out of 5. That's what we like to hear.
We're taking 7 out of 8 or 8 out of
Maria,
7.
thank you. Maria Tadeo, out of Brussels, AMH, down in DC. What we didn't touch on there is something we talked about in the previous hour. This president took a lot of criticism in the summer for the way the administration handled moving out of Afghanistan. Lisa, on this particular subject, there seems to be a lot of support from Republicans because we haven't heard many complaints at all. A little bit of unity on that front on this issue at the moment.
And really, it's important to note that the U.S. strategy has been very different when it comes to communication, that it's been unprecedented with the volume of intelligence that's been released in real time to the people. Yes, this is a messaging war, and this is a concern about information, but I wonder if this is the new tactic, if this is the new war front at a time when you have the nuclear threat, but on the flip side, the cyber threat and the informational battles are the real way to go.
Some unity, Tom, on an important conversation, an important issue.
Yeah, there's two strands there. There's the unity there, and as we've heard from guests, and some of those are off-the-record conversations, folks, there seems to be a sea change, John, in the reality of social media and the speed of news. Separately from that is the cyber attack reality reported in the last 24 hours upon Ukraine. I don't have those details in front of me, but there's some modern digital stuff going here that's away from remembrances of World War II.
Trying to stay on top of a lot of stories, the geopolitics, the foreign policy, the data in America, the central bank effort, an ECB governing council member, the governor of the Bank of Latvia right now. An interest rate hike is quite likely this year. The headline just out. Keep practicing. Have you called Maria to apologise?
No, glaçon, maintenant, allons-y.
Tom Keane, Lisa Ravitz and Jonathan Ferro.
Ice cubes.
This is Bloomberg.
Ice cubes for my tank.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Been absolutely whipsawed by headlines over the last couple of days around the situation in Ukraine. We've settled down, no drama this morning for now. Unchanged on the S&P, on the Nasdaq, and on the Russell, positive about 0.1%. In the bond market, a lot to talk about. Treasuries, 2s, 10s and 30s look like this. 10s at the moment, just north of 2%, picking up on 30s. Yesterday, the highest since May, 2.3498%. That's 235. 157 on 2s, pulling back from those levels we broke through last week, through 160 off the back of CPI. That really hot CPI print, you can throw on top a really hot PPI print earlier this week and have a look ahead to retail sales in about an hour from now to set the stage for the Federal Reserve conversation. Switch at the board and let's set the stage for the conversation at the ECB and the BOE. The Bank of England, inflation hot, north of 5%, a fresh 30-year high, and a conversation around a 50 basis point rate hike. Sounds a little like what we're talking about over at the Fed. Over at the ECB, it's a little bit more nuanced. There's a process to go through here. We need to unwind QE and then have a little bit of a chit-chat about an interest rate hike. And Tom, that's what's happening right now. The central bank governor of France is talking about winding down QE by Q3, and the central bank governor of Latvia is talking about an interest rate move before year end. It's not the 7, the 6, the 5 you've heard around the Federal Reserve. For the ECB, it might be 1. But you have to remember, Tom, you've got to go back to Trichet and 2011, the summer of 2011, for the last time they even made a move. So the fact we're having this conversation is a massive change.
Yeah, I agree. This is a huge deal, folks, in economics, which is the regret of central bankers. They're human. They get it wrong. And maybe Mr. Trichet, a good friend of the show, got it wrong. But everyone remembers that, John, and it is tattooed on the mind of every banker in Europe.
We've talked about this issue with Mr. Trichet before, Tom. We've gone over the history. I think he knows that was a mistake. This is a different backdrop now. Inflation's not at 2 or 3. It's not all driven by what's happening with crude and energy prices. It's more than that. Euro dollar off the back of this story, 113.78. Cable, 135. And let's call it 60. That's the cross-asset price action. Let's get you some single names, some movers, and say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Keep an eye on chip stocks. Remember, yesterday, the Philadelphia Semiconductor Index, that was the big outperformer, up about 5.5%. It looks like some of those gains could be added to today. We did get Analog Devices earnings crossing the wire just about a half an hour ago. They were pretty good here. They beat not only on those fiscal first quarter numbers, but the guidance that they gave for the fiscal second quarter also coming in well above what the street was looking for. Those shares higher by about 2%. After the bell tonight, we're going to get Cisco earnings. We're going to get Applied Material earnings, which is going to be a nice little read here on some of the supply chain bottlenecks here and whether any of these companies are actually expanding capacity. Remember, Applied Materials doesn't make chips. It makes the machines that makes the chips here. And NVIDIA, that's the granddaddy of them all, also coming after the bell. Remember, this was the best performing stock in the SOX last year. It started off this year on a down note. It was down as much as 25% at the end of January. January. It's rallied about 10% over the last couple of days, higher today in the pre-market by about 0.5%. You guys are keeping an eye, of course, on those retail sales numbers that are going to be coming out in less than an hour. We did get some earnings out of Shopify. Gross merchandise volume rose by about 30% year over year. The problem was it was rising at about an 80-90% clip back during the pandemic, and that's really what a lot of people are focused on here. Not whether the consumer spending is strong, so to speak, but whether it matches up or can sort of keep pace with some of those pandemic levels. Macy's and some of the department store stocks could move on the back of that report. Macy's shares are actually higher here on the day right now, Tom, by about 3%. This is primarily on an upgrade over at Evercore ISI, and we got Airbnb numbers last night, Tom. I know you've never probably ever stayed in an Airbnb, but they're actually doing pretty well, about 80% growth year over year.
You know, I got the walk up in New York. We rent it out as an Airbnb, but we don't get a high price because it's a 6th floor walk up.
6th floor.
It doesn't work. I tried. The guy below me, 2 floors below me, he's doing Airbnb like every other weekend, making the rent. And 6 floors, they just won't walk up. No. That's the research.
No, you gotta move, Tom.
Romaine, thank you so much. To close this afternoon, we've got cyber headlines out of the Ukraine that can wait, to be honest. Michael Collins is more important. I would note that the Secretary of State of the United States, Mr. Blinken, condemns Duma resolution on eastern Ukraine, maybe the first.
I thought you said they could wait.
No, that's one headline. That's not on cyber. That's not on cyber. That's like political.
Can I read the cyber ones? Can we make some time for that?
Okay, go over that. Okay.
Thank you. They say the attack continues. The cyber attack is still ongoing, Tom. It's shut down some government websites to prevent the attack. That's the latest out of the Ukraine. This was the worry of the US officials, Tom, if you remember. It wasn't just about a confrontation militarily. It was also through cyber too, and that seems to be taking place in Ukraine from what we're hearing from officials there.
Yeah, it's a tried and true method we've seen before, without question. We've never seen a bond market like this. It is original. Michael Collins runs real money at PGIM Fixed Income and joins this morning. Michael Collins, what is original about this yield up and price down?
Yeah, it's a very different cycle. I had a client ask me, what does this remind you of? And, you know, like every cycle, Tom, they all have their nuances. And we were just kind of gotten through this COVID pandemic, which none of us have really lived through. And now we're going through this huge global broadening inflation surge and a gigantic, you know, abrupt, hawkish central bank policy response all around the world. You mentioned the ECB, the BOE, the Fed. I mean, everybody, the Central Bank of Brazil, they're all in, except, of course, China. And it is different, right? So you do have to kind of recalibrate your ranges. I mean, coming into the year, we're thinking, you know, 1 to 2, maybe on the wide end of the range for fair value on a 10-year seemed right. And I think that number is higher now. But again, over the long term, we still are sticking with the view that things will moderate. And let's say in 2 to 3 years from now, that 1 to 2 range will still probably be in play.
Our viewers and listeners, I think, have a real understanding, Michael Collins, of in the equity market when somebody builds cash 3% out to 5%, 4% out to 7%, whatever. Do guys like you in the fixed income world, do you build cash in a time like this?
We don't, right? So we will go long duration, short duration, in and out the yield curve. If you want to take down credit risk, you will add to treasuries, and we've done exactly that. We've lowered our credit risk in light of the fact that there's a much higher probability of a central bank policy mistake or just a broader policy mistake, maybe a geopolitical policy mistake. So because of those tail risks that are really elevated in our mind, we have cut credit risk. And one thing you do is you go into safer things, maybe higher quality bonds or treasuries. And interestingly, there are a lot of interesting excess return or total return opportunities in the old-fashioned treasury market.
Here we go. You said that and you were smiling because you know I'm going to ask the question, Mike. Every time I see yields tick higher, I think of you. I think of the team at PGIM starting to nibble, starting to buy. Have you been buying at the long end, Mike? And what's the strategy there?
So what we've been doing, Jonathan, is adding to the position in the 20-year, but maintaining a big curve flattener. So our overall duration, we haven't been adding to duration here. We've been kind of maintaining it, even trimming it a little bit in some parts of the curve, really looking for a better entry point, right? I mean, I don't know where this thing is going to shake out. I don't know how many times the Fed is going to hike rates. I don't know when inflation is going to roll over. So we're really kind of biding our time here, waiting to see more signals that inflation is going to roll over. That's going to be a really important signal. But there is a lot of value in parts of the curve, like the 20-year Treasury. You can go long that and hedge it with 10s and 30s. I know this is really kind of inside baseball stuff. So you're not taking any interest rate or curve risk, but you're adding a lot of potential alpha to your portfolio.
And Lisa, what's great about this is we got Michael Collins doing the Macarena on TV or on radio. You're not seeing us. We got our hands up as we do the 10s, 30s Macarena.
Thank you, Tom.
Am I doing
glad
it
that
okay?
Oh, that's beautiful.
I learned it from Frank Fabozzi.
That is special.
Frank, thank you so
There's
much.
so much specialness right now. I don't really know
Here's
where to
the
go.
2s, 30s
So going
one.
over to Mike Collins. Oh my God, Tom Keene, you're making me
Who
lose
gave
it.
him his coffee this morning, Lisa? What is
All
in
right,
that
Mike
cup?
Collins, let's go back to the 20-year auction because they've got $19 billion of auction, and I want to talk about what you were saying, which was actually really interesting. Have you changed your view on where the end rate will be for longer-term treasuries? Because you were actually of the view that we'd already seen the peaks and that they were going to go down. Now we're at 2%. How have you shifted?
Yeah, I mean, in this world, right, when you're investing money, Lisa, as you know, you just like the Fed says, you have to be nimble, right? And you have to really be willing to be flexible. The biggest mistake you can make is kind of sticking to something regardless of new information coming in. The new information is that, you know, inflation has been a lot stickier, a lot higher, and it's actually broadening out as we sit here, right? So the conviction we have that it's going to be at 3% at the end of the year is much lower now than it was 6 or 12 months ago. So, you know, I don't know. I still think we're getting really close to the high end of rates. I mean, 30 years, as you talked about, are, you know, in the 2.30 range, and 10 years bouncing around 2%. I mean, yeah, can everything go a little bit higher? The 2-year can, right? The 2-year is still at risk here. We're still short that part of the curve, because if the Fed really pulls off 7 hikes this year, wow, that front end can still get whacked. So being in a flattener, I think, is still the right trade at this point. There's still some room to go there. But the long end of the curve, wow, it has a lot of value. I don't know where it's going to end this year, where it's going to peak. We're probably really close. But in 3 years from now, those yields are going to be lower, right? And that's where the value is over the long term.
Mike, are you free at 1 p.m. on Friday? Just for 25 minutes.
There you go.
Sure.
He wants to have a more in-depth and
Mike Collins of PGIM.
serious conversation.
Coming up later this week on Bloomberg Real Yield for a conversation uninterrupted on the bond market. Thank you, Mike, as always. Citi put this out in the last 24 hours on the data that we've seen, and this speaks to what Mike Collins is talking about here at the front end. The PPI report and its implications for core PCE are very consistent with the idea that US inflation is now stably running well above target and is not slowing down. They go on to say, increasing our confidence that the Fed will respond aggressively, including with a 50 basis point rate hike in March. TK, that's the call from Citi.
Oh, they're all going to vary. And I'm sorry, John, we're an hour and 50 minutes, 50 minutes away from another data adjuster to all those guesstimates.
Do you think retail sales can change the story for this Fed next month?
It's a secondary statistic, clearly to key data, but every data point now matters in this parlor game.
Bramo's nodding.
Yeah, I think it could change the conversation.
You think it could?
Because right now, you've got the damned if you do, damned if you don't. They hike too quickly and they could cut the economy off. They don't hike quickly enough. They cut the economy off because inflation crimps consumer demand.
Rock in a hard place.
Dance okay?
Do you want to do it again? Just for the people who missed it, Tom.
No,
it's pretty special.
We lose it.
What's important is when in the equities you do the 5-ratio DuPont dance.
What's that go like?
It's like when I do Renegade on TikTok.
Nice.
Please go on.
Nice. What is your TikTok handle, Tom? Do you want to share that with us?
No, it's private.
You want to keep that private? Maybe keep that private.
My handlers say keep it private.
Lisa
Brown. Renegade is, it's
Jonathan
easy to
Ferro.
do.
Futures down a third of 1% from New York. This was special. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Mariska Gupta. Investors will get fresh clues today on the Federal Reserve's next moves. Minutes from last month's policy meeting will be released. There's speculation that the Fed may act more aggressively to get the highest inflation in 40 years under control. That could include a larger than expected interest rate hike. Former Alaska Governor Sarah Palin has lost her defamation case against the New York Times for a second time. A jury found for the newspaper a day after the judge said he'd throw out the case anyway due to weak evidence. The case had to do with an opinion piece incorrectly linking Palin to a deadly shooting. Her lawyer hasn't said if she will appeal. And sluggish corporate travel demand is holding back the recovery in the hotel industry. Hilton posted fourth quarter earnings that missed estimates. A key industry metric, revenue per available room, more than doubled from a year earlier, but still it was down 14% from the fourth quarter of 2019 before the pandemic hit. And Meta platform CEO Mark Zuckerberg calls the company's employees MetaMates in a new memo on corporate culture. The founder of Facebook changed the company's name in December to reflect a newfound focus on the so-called metaverse. Zuckerberg retained the old motto of move fast. He added several others, including build awesome things and live in the future. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Companies
are experiencing inflation, but they're pushing it through to their consumers, and the consumers are paying up. So that's good news for margins. That's good news for earnings and for the stock market. Consumers can pay up.
That was Linda Dissel there, the Federated Hermes senior equity strategist, with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Futures down 0.2% on the S&P. We pulled back just a little bit on the Nasdaq as well, down 28, down about 0.2%. Lots to get through the next hour, 8:30 Eastern. So 42 minutes from now, get retail sales in America. Later this afternoon, the Federal Reserve minutes, and then we have a bond auction in between. Lisa mentioning this one, $19 billion of 20-year bonds, 1 Eastern. Yields in a single basis point, Tom, on 10s, 2.0329%. Crude a little higher, up 1.5% to 93.40.
John, thank you so much. What we're going to do right now is just take a pause here within all of the news that's coming out of Europe and just sort of look at the American landscape into this important retail sales group. Kriti Gupta, coming off of Valentine's Day, of course, looks at your lack of personal disposable income, because it was all spent on Valentine's Day. She's got something to do with the lack of savings today. What do we got?
Yeah, well, exactly. We said personal savings as a percentage of disposable income. That's going to be really important, because if you actually look at what happened with all the fiscal stimulus that really got kind of deposited into essentially bank accounts, well, it skyrocketed to the highest since the Great Depression. I mean, think about it. After the Great Depression, people were so scared of losing their money, they literally saved all of it for a rainy day. So to see that same kind of metric, that same kind of skyrocketing in 2020 is pretty significant. And that's also fueled things like retail sales. My chart of the day shows that dynamic going all the way back to the early 70s, where really you just see this kind of decline from the 70s down to 09, the idea that people aren't saving as much as a part of their income.
John, I'm going to tear up here. I mean, and for radio, it's come back. You're doing log personal savings to the savings to personal.
I am. You've rubbed off on me.
You're killing it. I mean, you didn't drink the Kool-Aid. You drank the Tang. It's come back to where we were, right? That's the headline.
Right. It's come back. Well, almost there. We were at 7.1% before the pandemic hit. We are now at 7.9%. So it's retreating from those levels. But at its peak, we were almost at about 35% of your income was essentially being saved, and that's why you saw so many loans being paid.
That never happened at the Keene house.
Well, Kriti, honestly, this is such an important point, because right now the rock and the hard place that John was talking about for the Federal Reserve, the ability for them to be able to curtail inflation before it becomes a self-fulfilling prophecy and slows the economy down. Can you weigh in on the fiscal drag, which we talked about for a long time and then suddenly heard nothing about? That we're expecting to get a $1 trillion fiscal drag this year, the most in years, as some of those programs roll off. Have people factored that in and tried to extrapolate out how much that really will impinge the savings rate?
Well, what's interesting is the timing of this all, right? Because people were saying that the impact of that fiscal stimulus, essentially, that we got in 2020 and arguably the first half of 2021, well, it would roll off by the end of the summer of 2021. And yet you are still seeing that kind of fuel a lot of spending, especially into the holiday season that we saw last quarter. So to your point about the fiscal drag, well, take a look at what's actually getting pulled down in retail sales over the last couple of months. We'll push this ahead to the data we're getting at 8:30. The actual declines that you're seeing are in those COVID-sensitive sectors. You're seeing it in restaurant spending, you're seeing it in gas stations, you're seeing less spending, I should say, even in things like cars, for example. So some of that disposable income that would essentially be spent on perhaps going out, taking those trips, commuting more, that's really where you're starting to see the squeeze. And put that into perspective with Lisa, you've been talking about this for weeks on end, higher gas prices, higher inflationary prices, feed that into the fact that now you have less money to actually spend, in addition to the fact that real wages aren't catching up broadly as well. So you have really a flurry of issues here.
Kriti, one thing that you do so well is you take a look at the economic read-through and then get a sense of the market response. Are you seeing a greater market volatility in response to every data point because we don't know which data matters the most for the Fed?
Sort of. The knee-jerk reactions seem to be more volatile, but then they get all paired. And besides really the CPI report and things like FOMC minutes, of course, Fed Day, the rest just kind of, you have this knee-jerk reaction and then it comes right back. And it happens within, say, 10 minutes of the data release. So it's a very quick kind of tradery, algo-y move. What's important to keep in mind, though, is what this means for the long term. I think Gina Martin Adams has been repeating over and over and over again that margins is what matters. Well, the reason earnings are so good, the reason corporate America has been able to put up so so much margins is because of that consumer spending ability. They're able to eat those costs that are passed on.
You know, to both of you, Lisa, dive in here. I mean, I think this is really, really important, is that we got retail sales coming out in 38 minutes, and we treat it homogenously. And I'm sorry, on a savings basis, the difference between Louis Vuitton, they're raising their prices today. This is out. They're raising their prices. Luxury's going up. But is Walmart doing that, Lisa? I don't think so.
And we get Walmart earnings tomorrow before the bell, probably around 7 a.m. Eastern. And there is this issue right now of whether you do get starting to get pushback. And then, of course, there is the idea of the Fed. What actually can they do? I mean, raise rates, or are they going to really engage that balance sheet?
Fed Minutes coming up a little bit later. Critty, thank you. Let's get back on top of the news, the headlines out of Ukraine. Here's a story at the moment. US and EU countries helping Ukraine with cybersecurity, according to an official. Tom, the cyber attack aimed to destabilize Ukraine. They go on to say, these are the headlines out of Ukraine, that Ukraine shut down some government websites to prevent the attack, sees no infrastructure or financial losses from this attack. Tom, they say the cyber attack against the Ukraine is purely psychological. Some of the headlines coming out in the last 30 minutes or so.
I don't know how you stop that. I mean, you don't have a Minsk Accord on cyber attack. I mean, it's out there. It's technology getting hacked. It can be individuals. And what's critical, John, is this is not just about Kiev. It goes all the way west to Lviv, where the U.S. Embassy moved to. It's all of the nation. It's not just, you know, one building or that.
It's something the administration in the United States was worried about, Lisa, that they have to have this battle on several fronts.
That's why I think that probably the biggest takeaway from this whole conflict, hoping that it doesn't escalate, is the information wars and how it's being battled in a very different front. Russia's been doing this for a long time. The U.S. is now increasingly responding in kind, although perhaps not with the same kind of on-the-ground campaigns, but certainly taking their message very public and very quickly.
The latest we've heard from Ukraine, from that one official, is that the Ukraine says a cyber attack still continues. We'll stay on top of that. Futures just edged back a little bit here, down 11. No drama at all. We're down about 0.25% on the S&P, and the Nasdaq 100 down 28, down 0.2%. This market again is set up now for the retail sales print, 8:30 Eastern time. That's in about 35 minutes time, Tom. Yields come in a single basis point ahead of that at 2.03%.
I'm going to note, John, over 2 days, curve steepening. We've gone from the angst of 39, 40 basis points out to 47. That's demonstrable. That's a nice steepening over the last 24 hours.
Have we baked in enough into the front end, Lisa? Maybe. That conversation around 7, can you do more than 7? That's every single meeting this year at 25 basis points. The view from Goldman, the view from Bank of America. Have we really discounted central bank balance sheet reduction? No. That's the unknown for me, for you, for Tom, for others too.
I also think that we also have the unknown of how much can financial assets take. We always have seen that central banks can raise rates less in each subsequent cycle based on how much debt. How do you then pair that with balance sheet reduction? I wonder how we even begin to price that.
Do you think financial markets can take any more of Tom's dancing? He's sinking.
I'm not
His French.
Sure. I don't know. You're doing great.
Do you think we can get through the next hour? Every
Doubtful.
time he does that, futures go a little bit lower. You're down, Tom.
Thank you,
down 48. From New York with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. On radio, on TV, this is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Like, just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The market is pricing in today what's going to be a transition year for the economy.
I think it's going to be volatile here for a while.
In a more volatile market environment, the option value of cash increases.
We think it's probably a good idea to have some cash on the sidelines.
Investors also need to be patient to figure out what's going on here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television across this nation. We welcome you. Retail sales in 30 minutes, an important consumer metric, the buoyancy of this economy, and John, the distraction of Ukraine, Russia, and indeed of Washington, the Secretary of State moments ago with a statement.
Let's get to that statement, Tom, and I'll read it out verbatim, just the first few lines from Secretary Blinken. It starts like this. The Russian Duma has stated that it plans to send to President Putin an appeal to recognize the so-called Donetsk and Luhansk People's Republics as, quote, independent. He goes on to say, to be clear, Kremlin approval of this appeal would amount to the Russian government's wholesale rejection of its commitments under the Minsk agreements, which outline the process for the full political, social and economic reintegration of those parts of Ukraine's Donbass region controlled by Russia-led forces and political proxies since 2014. Enactment of this resolution would further undermine Ukraine's sovereignty and territorial integrity, constitute a gross violation of international law, call into further question Russia's stated commitment to continue to engage in diplomacy to achieve a peaceful resolution, Tom, of this crisis.
Very direct, and you wonder, after what we saw in the press conference yesterday, how Moscow will react. John, I listened to that press conference off of, I believe, C-SPAN in translation, and Mr. Putin was direct as well. So maybe this is the beginning of where conversation actually starts.
That conversation continues. That statement ends, Tom, with saying that if the president did that, it would, quote, necessitate a swift and firm response from the United States in full coordination with our allies and our partners.
We'll have Maria Tadeo dissect this through the morning as well. Futures at -9, Dow futures at -61. John, I see a little bit of a market move here.
We're down about 0.2%. It's no drama, Tom, just a bit softer. Down 33 on the NASDAQ, off by 1/4%. Yields at a single basis point. The data out in 28 minutes' time. Retail sales in America, we're down a basis point to 2.0347. Crude's higher it was before, 93.27, up by 1.3%. No big changes here, Tom, as far as I can see. Just a slight, subtle, softer move lower on the S&P.
I like that subtle move, and you see that in Swiss franc with some Swiss franc strength as well. What we're going to do as we get ready for retail sales is take the pulse of economics, finance, investment. That's what we do. And on radio and television, we welcome Brent Schutte, Chief Investment Strategist at Northwestern. This is long-term money. What's your short-term, Brent? Is 3 years short-term for Brent Schutte?
Yeah, I mean, certainly we try to navigate the markets for our clients. We look longer term, but adjust shorter term. And in the near term, we do see inflation pressures receding despite all the hysterics about inflation and the back data that shows that inflation is high. I think you're going to see inflation cooling in 2022, and that's going to be the impetus for a move higher in the markets.
What is the opportunity given hysterics?
You know, that's a good question, because lately you've seen investor sentiment sour, which typically is a very good contrarian indicator. A few weeks ago, we had an AAII bullish sentiment survey of 21. It's only been lower than that 58 times back to 1987, and 56 of those gave way to future market returns that were higher. And so I think that's a good way to think about the markets and think about what everyone always says, climbing the wall of worry. I think you're going to climb it again this year, unless you believe the economy is going to be forced into a recession by the Federal Reserve, which we don't believe.
Wait, Brent, you think that that's the threshold? So that has to be a recession in order to really tank market valuations, and not just a deceleration that's more than people currently expect?
That is what the data would suggest, at least looking at history. I mean, certainly if the economy is higher, the market is higher. There are certainly nuances within that, but if we are sitting here a year from today and the economy is still pushing forward, I would suggest the market would be higher. But I think it's in different areas of the market that have valuation cushion. And so if you think about the S&P 500, it has a 5% earnings yield. The S&P 600, which is quality small caps, has a 7% earnings yield, which is a bigger cushion relative to rising interest rates. And I think where investors should focus in 2022, focus on the here and now earnings, not those that are far out in the future.
Brent, can you do that, though, if we've already brought forward so much of our earnings expectations? And this has really been a conundrum, that if you've already taken a look at interest rates where they are and valued profitability out 10 years based on that interest rate, that all of a sudden it's sort of a higher bar to cross, that the oxygen's getting kind of thin. How do you argue then against people who point to earnings revisions that have been downward and downward at the fastest pace in years?
Sure. I mean, certainly they're going to come downward off of those high levels, which were accelerated by the COVID opposite side of the COVID recovery that we had. There's no doubt math is math. It has to decelerate just because of math. But I don't think that's going to be the death knell for the stock market. Typically, the death knell for a longer stock market decline is a recession. Right now, I would think the only way that we would have a recession in the next year would be if the Federal Reserve had to get really aggressive and had to hike rates because expectations became unmoored. The five-year forward is at 2.12%. I don't think that's unmoored. I don't think the Fed has to behave like it's 1980, even though we keep making comparisons on the inflation data back to 1980. That was a very different time period. The Fed still has their inflation fighting credibility. Certainly there's risk there, but I do think you're going to see a market that is pushed higher. And just for perspective, that 7% earnings yield means that those stocks are trading at 14 times earnings, which is historically cheap, not just relatively cheap.
Brent, so important here, and this goes to the clientele, the corporate and business nature, the commercial nature of Northwestern Mutual. What is the response you have to a fully employed America?
I'm not for sure we're fully employed yet. That's where I think there's some dissonance. I think you're going to continue to see people come back into the labor force. I think there are risks, and this is where I think in the second half of the year I become more cautious, because I think you could be getting closer to full employment, or back to where we were at least in 2019, which was closer to full employment. But I still think we have 4 to 5 million people to bring back into the labor market, and I think you're starting to see that happen. You've seen 1.4 million Americans in that January jobs report come back. You've seen NFIB, you've seen companies suggesting that it's not as hard to find workers. And by the way, that coincided, the peak in that was with the unemployment extended benefits that expired in September. And so I think that we still have room to go there. I am a bit more worried towards the back half of the year when we could be closer to full employment, but then I think it's a productivity story that carries us forward.
Well, the productivity story is very important, and that does include a labor component. If wages lift, how does the Fed react? And then how does that redound onto people's portfolios and investment?
That's where the risks are, and I think that's what Lisa's mentioning. I mean, as you get towards the second half of the year, if wages are rising because we are running out of employment or employees to actually hire, then we need productivity to enhance to keep up with those wage increases. And that's where I think people are going to be waiting to see if all the technology that was pulled forward, the robotic installations that we have, if those actually pay fruits, then we're good. If not, we could be in more trouble in 2023, could be a year where we're talking about the end of an economic cycle, but I just don't think we're there yet. I think we still have room to run. I think there's some positive news on the horizon that will lift us, and so we still are optimistic as we look into the first half of 2022.
How much conviction do you have, Brett? Are you hedged as you invest more fully into Russell's 2000?
We're not in the Russell 2000, so I think there's a difference there. The S&P 600 is much higher quality because it has to have earnings, whereas the Russell 2000 has a large proponent that doesn't.
Okay.
Our conviction has certainly waned. I mean, in April 2020, we went max overweight equities, and we took some of that off last year. And we certainly are hedged a bit more. We own gold, for example, but we still want to own equities versus fixed income. And we have a tilt towards things that are cheaper, not just the S&P 600, but also value style, things of that nature that will do well, we think, as people pay heed to valuation. And I should note that, the market is certainly off, but most of the damage has been done in really high growth stocks with earnings far out. The damage is much, much less in things like value, things that are actually cheaper. And I expect that to continue.
Brent Schutte, thank you, sir. Thank you very much of Northwestern Mutual. Here's a story for you, Tom. Picture this story. Steve Schwarzman wants to be your landlord. This is the lead paragraph in the Wall Street Journal. Blackstone has agreed to buy rental apartment owner Preferred Apartment Communities in a $5.8 billion deal that demonstrates the strong investor demand for multifamily properties in Sunbelt states. Story goes on to read, Atlanta-based Preferred Apartment owns over 40 rental apartment properties, Tom, with about 12,000 units in states including Georgia, Florida, North Carolina, and Tennessee.
This is Joel Murphy out of the South. I've known the name for years, John. He's out of Chapel Hill. He's on the board of Orvis as well. This is a real Southern acquisition by Blackstone. It speaks to multifamily, but I would really emphasize the name is a little deceptive in that Preferred Apartments does more than just apartments. It's pretty much a blended real estate acquisition. Within this emotion is Steve Schwarzman and others in New York buying up apartments from sea to shining sea.
So as I read the story, about 70% of the deal's value is in rental apartments, Tom. They also own 54 shopping centers as well, which is the point that you're making this morning. Lisa, how long before this becomes very, very political?
It already
in
is.
a big way.
It already is.
This already is. I mean, take a look at rents that are climbing at the fastest pace on record in many places, surging across the country. They are not slowing down. They are accelerating. Home prices have increased so quickly, and you hear anecdotes about first-time home buyers being bid out before they can even get in to see the apartment because of these institutional buyers. At what point is there some sort of pushback? And can we calculate how much of a bid that's really given a housing market that's just on fire? I mean, really.
All I can say, John, is it's there, and the key phrase is what Bramwell just said. It's on fire. You see that, John? In my walk up, there's an apartment down the hall. John, we could live down the hall from each other.
We used to.
There's an apartment that just went up $500 in rent off of like a year or 2 years ago. I mean, that's the metric. Granted, it's New York City and it's a walk up, but John, those are the metrics everybody watching and listening is feeling right now.
They're going up in a big way. Lisa, do higher interest rates change this? Do we see less of this with higher interest rates? Or is there a rush to do more of this before they actually start going up?
Honestly, a lot of people look at rental properties as an investment, as an inflation hedge. I mean, talk about this for irony, that actually could push people further. If you get rates that are higher, people can then pass along those rates to rental costs. At what point does that become a self-fulfilling prophecy?
That story from the Wall Street Journal, Blackstone to buy Preferred Apartments Communities in a $5.8 billion deal. Futures are negative, 0.25% on the S&P. Yields are lower by a single basis point to just north of 2%, 2.03% from a beautiful New York City with the sun rising in about 20 minutes' time. Retail sales in America from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Russia has announced that more troops are returning to their bases after Maneuvers ended in Crimea, but Western officials remain cautious. NATO Secretary General Jens Stoltenberg said there's no proof of de-escalation on Russia's part, and the Kremlin hasn't announced pullbacks of large numbers of troops along the Ukrainian border. Moscow has rejected warnings that it's planning to invade Ukraine. In the UK, inflation unexpectedly accelerated for the fourth month in a row. That's a surprise that adds pressure on the Bank of England for a supersized interest rate increase next month. Annual price growth in January rose to 5.5%. That is a new 30-year high. And it's a standoff in the Senate Banking Committee. Republicans on the panel blocked votes on President Biden's 5 picks for the Federal Reserve. The dispute has to do with only one of the nominees, Sarah Bloom Raskin. She's the nominee for Vice Chair for Supervision. Republicans say she hasn't adequately addressed questions about her role as board member of a fintech company. Senate Banking Chair Sherrod Brown says he'll reschedule the votes. And China's President Xi Jinping has ordered Hong Kong to get the city's coronavirus outbreak under control by all necessary means. That's an unusual intervention that could lead to stricter measures and possibly a broader lockdown. Xi's remarks came after Hong Kong Chief Executive Carrie Lam said the outbreak had overwhelmed the government. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Season continues.
To the metaverse, to Spotify, to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's a tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
Let me just say, first of all, that our hope is for peace. But if troops or tanks cross the border, we're prepared to levy the most severe sanctions on Russia in its history.
Dileep Singh there, the Deputy National Security Advisor from New York with Tom Keene and Lisa Abramovitz. I'm Jonathan Ferro. 12 minutes away from retail sales in America. Futures down 9. We're down 0.2% on the S&P. In the last 20 minutes or so, the State Department just laying out a plan of what they would do to respond to the president of Russia if indeed he recognized Ukraine's separatist provinces, Luhansk and Donetsk. He said it would constitute a gross violation of international law. Secretary Blinken went on to say it would, quote, necessitate a swift and firm response from the United States in full coordination with our allies and our partners.
Extraordinary. And we don't have enough time this morning then with Greg Valliere, our Chief U.S. Policy Strategist at AGF Investments. His morning note read in all of Washington. Greg Valliere, let me start with this discussion. I know there's other topics at hand. An absolutely stunning direct statement. Does it garner bipartisan support of Congress?
I think so. I think, Tom, that most Republicans, headed by Lindsey Graham, will go along with this. But this is pretty harsh. I mean, I think that there had to be some sign of conciliation on both sides. You know, since the fiasco in Afghanistan, it seems like this administration in Washington has gotten a testosterone implant. They're talking tough.
International relations would suggest that Putin, historically through 4 terms, always wants a bilateral discussion. Does Mr. Putin speak to America separate from the allies?
Maybe, but I think the intermediary to watch, obviously, is Macron, who has his own election to worry about in April. But I think Macron will be a good middle ground seeker that I think he can make it. He'll talk about security for Russia without sounding as strident as either Putin or Blinken.
Macron spoke to Xi today. Greg, how important is China in the mix here?
It's huge. I mean, if this ends badly in Ukraine, everybody will immediately start talking about Taiwan. So, and with the Olympics over in about 3 or 4 days, I think that we have to look at the rhetoric coming out of Beijing.
Just getting a headline from the Elysee Palace that Macron reminded Xi of the importance of Ukraine's sovereignty. These are the international issues, Greg. They will have domestic implications. The oil story, the energy story is pretty obvious. There's something that typically you and I, Lisa, Tom, would be covering almost every 15 minutes. It's the Fed picks, and we're not talking about it. Greg, the Republicans aren't picking a fight with the president on the foreign policy of the moment. They seem to be in agreement on the approach of this White House. They are picking a fight on the Fed picks, more specifically Sarah Bloom-Raskin. Greg, what's going to happen here in your mind? How do you think this evolves through the coming days and weeks?
I think 4 of the 5 get confirmed, headed, of course, by Jerome Powell. He definitely will get confirmed. But I think the 5th, the controversial pick of Sarah Bloom-Raskin, I think she's on thin ice right now. It's got very little to do with this company she worked for out in Colorado. It's all about the Fed's mandate. And there are Republicans who feel that have exceeded the mandate, which really stipulates only that we have stable inflation and full employment. She's gone beyond that on environmental issues.
So she's gone beyond that with environmental issues, but is there a clear message from senators when they're grilling some of the Fed nominees about what they want the Fed to be doing, how much they want them to be aggressive with respect to inflation?
Yes, aggressive in terms of inflation, yes. The other issue that I think has to be considered is how aggressive this administration is going to be on regulatory policy, headed by Gary Gensler at the SEC. And now if you have Sarah Bloom-Raskin confirmed, you've got an environmental climate that Republicans and business are not going to like.
Yeah, when you talk about some of the regulatory issues, I was thinking of the block trading crackdown that we've been seeing recently. I mean, is that something that resonates among voters? I'm just trying to wonder as we get this potpourri of issues from Democrats trying to get out from under the main issue, which is inflation, frankly. What's sticking? What's going to be the main talking points as we head to mid-year?
Yeah, I think the main talking point is that we are vigilant against inflation. If they start talking about regulatory reform, people's eyes will glaze over. So we're tough on inflation. We'll do what is necessary. And I think if there's a long fight and we don't get all the confirmations done for a while, and maybe Sarah Bloom Raskin has to withdraw, that's not going to resonate with the American public. They want to see tough talk on inflation and action.
Greg, do any incumbent Democrats remain in Congress? I mean, the rate we're going, you get to August, they're all gone.
Well, we went up to 30 yesterday, Tom, as you know, 30 members of the House not coming back. And you've got several senators in trouble as well. So they're going to grasp at straws. The straw right now is maybe to end the gasoline tax, 18.4 cents a gallon, for the rest of the year. I think that's a gimmick. I think people will acknowledge that. And most importantly, on the left, environmentalists will go bananas. This is something the environmentalists would strongly oppose.
Greg, final comment from you, just on inner city crime right now. Greg, how do they start to own this in a better way?
It's a tough one. You got, John, you've got inner city crime, illegal immigration, inflation. There are so many issues right now that cut against Biden that the bottom line is that not only will the House go to the Republicans, the issue is by how much, and it could be 20, 25 seats, maybe more.
Wow. Greg Valliere of AGF Investments. Thank you, Greg. As always, that last issue, Tom, just a massive issue at the moment.
Well, it's a calendar, John. I mean, again, it's February, which I can't believe it feels like May or June as we go to retail sales in 6 minutes. But, John, what's so important here is this midterm. To me, it's all starting way earlier than anybody expected.
Well, let's start with the economic data. Is the calendar of the economic data, Lisa, is it on their side? On their side, because the good news is the midterms aren't tomorrow. They're not next week. They're near the end of the year.
They were expected to be on their side, the calendar dates, because you were expecting a deceleration in inflation, and yet we haven't seen it yet. And I think this has been the big issue, and the reason why PPI data that we got yesterday was actually quite interesting to me. There were no signs of deceleration that a lot of people were expecting. So if we don't get that, how much does that really tie the hands of people who've been saying, it's not transitory, but it is going to fade?
Which is why the likes of Citi and others are looking for 50 basis points on March 16th. I can see out the corner of my eye Mike McKee in the chair, Tom, ready to go at 8:30 Eastern to break down these retail sales numbers.
It's very retail sales, and again, the control group matters. But, John, to be honest, it's sort of like the jobs report. There's so much data beneath the headline data that it can be very valuable.
We'll get Mike McKee to break that down for us in just a moment. Let me whip through the price action. This is how the stage is set. 5 minutes out from retail sales in America. Futures come in a couple of basis points, couple of tenths of 1%, down 8 points on the S&P. Let's call it 7. On the Nasdaq 100, down 26. We're down 0.2 of 1%. In the bond market, yields are in a single basis points to 2.0329%. Crude is higher by 1.2% to 93.18. The numbers you need to look for: the retail sales control group, the estimate 1.3%. The previous read negative 3.1. Month on month, the headline number, we're looking for 2%. That's your median estimate. The previous read negative 1.9. The numbers just around the corner with Tom Keene, Lisa Abramowitz and Jonathan Ferro. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
The main data point of the morning, just seconds away. Retail sales in America. Mike McKee ready to break that down for you. Futures going into it, down 0.2% on the S&P and on the Nasdaq. Yields in a basis point on 10s. The data drops. Here's Mike McKee.
All right, John, here are the numbers. Retail sales, a strong advance in January, a big rebound from what we saw in the month of December, up 3.8% on a headline basis. Remember, it was down 1.9% in the prior month. Ex-autos and gas up 3.8%. The forecast was for just 1%. And that retail control group you mentioned, which is what is the closest thing that goes into GDP, so economists watch this, that is up 4.8%. It was down 3.1% in the prior month. So it looks like Americans are still spending. There's been a sort of story out there that with the fall off in government payments that we would stop spending. But it looks like we are still spending some money, and that retail control is interesting because that does not include gasoline, and gasoline prices went up big. I'll let you check the markets and let me see what else moved this time.
The futures stay lower, Mike. We're down 0.2% on the S&P and on the Nasdaq too by 0.25%. What did turn higher off the back of this were just Treasury yields. They were down about a basis point on 10s, now unchanged on a 10-year at 2.04%. We turn a basis point higher on a 2-year yield to about 159. Seemingly nothing stopping the Federal Reserve at this point, at least on the scheduled data, stopping them from hiking anytime soon, Tom. That is a really nice upside surprise on U.S. retail sales.
Let's detail this into what we hear from Fed speakers. And to me, the most amazing comment from Bullard was Steve Leisman yesterday and was Steve Matthews a few days before, is the president of St. Louis's Fed's belief in an optimistic real GDP. Bullard's up here 3-4% for the year, and a lot of other people are at a lower statistic. Does this kind of data buttress the Bullard optimism on the American economic experiment?
Well, to an extent, it buttresses it going into the March meeting, but of course it is just 1 month's data for 2022. But it does belie the story I was talking about, that we would see some depressed spending going into 2022. Let's take a look at some of the numbers that did go up here. Motor vehicle and parts up 5.7%, which is a nice rebound from what we had seen, and it does suggest that maybe cars are getting out there. Furniture and home furnishing stores now, housing has been huge huge, and a 7.2% increase in the month to January is significant, I would say. Building materials and garden stores, 4.1%. So again, housing and construction doing really well.
Yeah.
Grocery stores up 1.2%. Here's a surprise. Gasoline stations down 1.3%. Now remember, these are calculated in dollars. And if you look at the price of gasoline in January, it went significantly higher. In December, it was lower, but it was down, at least in terms of retail gas prices. But the total number of dollars spent on gasoline down 1.3%.
Mike, how do you understand the idea that retail sales came in hotter than expected? People are still going out there. They're still spending. How do you pair that with the University of Michigan Consumer Sentiment Survey that's coming in at the weakest readings going back a decade or more?
Well, the easiest thing I could do would be to quote Alan Greenspan, who once said years ago when asked about the consumer confidence numbers, we watch what people do, not what they say. Remember, those numbers show people think that the overall economy is terrible, but their own economic situation is pretty good. So there seems to be a dichotomy there that may be driven a little bit by us here in the news media. Let me just mention,
Why are you looking at me?
Non-store retailers, the internet shopping up 14.5%. Now that could be gift cards. Everybody's giving gift cards these days, and those don't count as retail sales until they are spent, and a lot of people spend them in January. So we'll have to take this apart more, but there could be a reason for that.
Mike, before you run, just in case anyone missed the conversation we've had through the first 4 minutes or so, just wrap this up. Does this capture price or volume? Which one is it?
This captures price, and so the 3.8% change in retail sales would also be something you'd have to adjust for inflation, but we'll have to leave that to another moment.
Mike McKee, thank you. Lisa, I know that's a point you've been on top of.
Well, and actually, Peter Cicchini actually noted that this was a key issue. If you strip out the inflationary pressures that have come in hotter than expected, in addition to revisions downward in the prior month in December, it doesn't look as hot as the headline might suggest, which might explain why you're not seeing an even bigger reaction in the bond market.
Just a bit flatter here, Tom. 30's down a basis point. Two-year yields up almost a basis point.
Curve flattening, 47 out of 46. That's all a little, I liked what you said earlier, John. Subtle's the word for the day. There's a lot of subtlety going on the Bloomberg terminal. Right now to interpret and drive forward, Simona Makata joins us, Chief Economist, State Street Global Advisors in Boston. Simona, thrilled to have you with us today. And my arch question out of the Bullard-McKee talk I just had is, does this kind of data assist you in deciding when inflation breaks? If we're at a high level of inflation, the game is the guesstimate of when it starts to roll over. Does retail sales today help with that?
I don't think so. I think what I see in the data is a lot of month-to-month volatility, and the January numbers were very strong, but put those against December, average the two, and you get something much milder. I think that's how you gauge what the trend of this economy is. I don't think the retail sales data specifically help you with the inflation question. Personally, I'm of a view that around mid-year is when we are going to see meaningful signs of inflation deceleration. It seems as though we are pushing on this string, and as time goes by and nothing becomes apparent in the data, we lose hope. But it's possible that when the change occurs, it occurs quite suddenly, and if you go from like nothing's here to there is plenty of evidence of inflation decelerating. But it's not today's data that helps that.
What is the linkage between an inflation and then onto a growth estimate?
Well, it's very simple. It's a basic econ concept. The higher the price, the fewer the quantity sold. So this is, high inflation. Think of it as a demand headwind. Of course, you can offset it if you have persistent income flow to absorb that inflation, wealth destruction or income destruction, purchasing power destruction. But in and of itself, high inflation will lead to lower growth.
Are we seeing, though, that that's not coming to fore the way that a lot of people are expecting? I mean, we were talking about how you're seeing sentiment deteriorate, but it doesn't seem to be dramatically crimping purchases. At what point does that start to give you a sense that maybe that narrative isn't working this time around?
The narrative works. The timing doesn't work precisely. And the reason it does not work precisely is that you have a consumer that in the aggregate still sits on a huge amount of accumulated savings. So you don't need to have a demand response immediately. What you can do, you can draw down those accumulated savings and still finance consumption in the interim. But if that works for a while. Eventually, there will be a demand response. It may not be apparent until the second half of the year. And let's not forget, even in today's data, you had a very strong help there from motor vehicles. There's still a lot of pent-up demand in parts of, of the spectrum, and that will still help. But this is the tricky part, trying to dissect, what is the real message here. I think you cannot take any single data point, put too much weight on any single data point, and try to take a view that takes you over the course of the year, not just for the next month or two.
What about the fact that we haven't necessarily seen inflation decelerate to the degree or even start to give signs of peaking the way that people had previously expected? How high does that mean that inflation could go? How much are you revising your estimates about the trajectory of this particular cycle?
Yeah, it's been a tough journey, I have to say. I think the inflation revisions are still upwards as of this point in time. I think what you are starting to see is leading indicators of a turn in inflation, things like perhaps things having to do with shipping costs, things having to do with expectations of inventory building, things having to do with expectations of wage increases. Just to give you an example, in the small business survey, for instance, you had current compensation, so current wage increases making a new record, but compensation plans decelerating. So this is all you see at the moment. So it's not even in the inflation data per se. It's in the leading indicators of inflation that you're starting to see some shift.
Got to leave it there, Simona. Thank you. Simona Mocatta, there of State Street Global Advisors. Thank you very much. At the top of the hour, 9 a.m. Eastern Time, a fantastic lineup on fixed income to get your teeth into this market. Subhadra Japa of SocGen, Bob Michael of JP Morgan Asset Management, and Matt Hornback of Morgan Stanley. TK, looking forward to a fantastic conversation about this economy and this central bank.
No question, better than anything we did this morning. But beside that, John, these are people that have to adapt and adjust. What I find fascinating is we launch into March, everybody's going to have to recalibrate. What do you recalibrate to? I'm not really sure.
Do you see how quickly they took that promo down when you said that? Tom, that's not true. And loads of great stuff this morning. Lisa Peacham and Mike Collins, he had a lot to say about this Treasury market.
I mean, yes, he was interrupted by the Macarena, but what he was talking about with the 20-year Treasuries got my attention because what you're seeing is an inverted yield curve between 20s and 30s. Basically, you're getting more yield from 20-year Treasuries because they don't have the liquidity, they don't have the base of buyers. And I just want to add this one thing.
Sure.
The Federal Reserve is going to stop buying bonds for its assets in March 9th, I believe, including for that 20-year notation. That could lead to a huge disruption in a market that really hasn't gained the same kind of traction as a 30, 10, and 2-year denominations.
We do the research as it comes out. The great Matthew Mishjan at UBS says, look, credit looks good now, June, July, then what? And his then what is this Fed has to walk a tightrope, or they're going to risk breaking corporate credit at the area where Bramo's familiar, triple C, triple D, triple E.
The junkiest of junk. Is that what Bramo's familiar with?
That's my gig.
The economic data in America, the CPI, a green light. The PPI, a brighter green light. Retail sales, it's flashing green. The Fed's ready to go. The middle of March from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. Investors will get fresh clues today on the Fed's next moves. Minutes from last month's policy meeting will be released as speculation that the Fed may act more aggressively to get the highest inflation in 40 years under control. That could include a larger than expected interest rate hike. The Biden administration said that new trade tools are needed to confront China. In a new report, the U.S. Trade Representative's office said that China's state-led model has harmed American companies and workers. It accused China of failing to keep promises to pursue market-orientated policies that it made to join the World Trade Organization. And the Swedish telecom equipment maker Ericsson may have made payments to the ISIS terror organization. CEO Porter Ekholm told a newspaper the money may have been used to gain access to certain transport routes in Iraq. Ericsson says it continues to, quote, invest significantly into an investigation into its Iraq-based operations. And Goldman Sachs CEO David Solomon says the firm will always have an in-person office culture. Solomon calls the office especially valuable for the development of employees in their 20s. He says that Goldman had opened offices in cities across the U.S., but the firm won't create jobs that can be done from remote locations such as Jackson Hole, Wyoming. Stanford University edged out Harvard as the biggest fundraiser in the U.S. Stanford raised about $1.39 billion. That's about $10 million more than Harvard. They were the only two U.S. schools over $1 billion. Rising stock markets last year helped fuel those donations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
People all around the world are retooling. Here in America, do you think Ford Motor Company and General Motors, which have completely retooled and are retooling their factories to build electric, do you think they're suddenly going to say, no, electric's not the future? Electric is the future for automobiles all around the world.
John Kerry, the former Secretary of State, a most interesting gentleman, and of course, the U.S. Special Envoy for Climate. I did a panel, thank you, Bank of America, Mr. Moynihan, with Secretary Kerry in Davos on climate, and I was thunderstruck at how statistically well-informed the senator was. I'm sorry, folks, it's Massachusetts. I still call him the senator. How the senator was informed legitimately on climate, whatever your beliefs in the topic. Of course, peer-to-peer conversations with David Rubenstein, it'll be most interesting as well. I was thunderstruck how this guy did not mail it in on climate. Is that what you observed?
He knows this stuff cold. This is the job he wanted. Most people, when they finish being Secretary of State, never want to go back into government because any position will be less significant than the one they had. He's so interested in this subject. He came back, in effect, is a subordinate to the Secretary of State. He's not subordinate, but he's not as significant as the Secretary of State, who used to be his deputy. Tony Blinken used to be the deputy to John Kerry. Now, Tony Blinken's Secretary of State, and John Kerry is in the State Department, but not as significant a position as he once had. But he wanted to do this because he really cares about climate change.
David, because of news flow, we have other topics, but one more question this morning on John Kerry. He's big time frustrated over where we are right now. Headlines today, I think water lease is going to rise 2 or 3 feet. Baltimore's Camden Yards is going to be flooded. I mean, climate change is going the wrong way right now for John Kerry.
We've had a lot of problems with climate change, and I think people recognize, I think he said in this interview, that it's here, it's something we have to do something about, but the truth is, it's nothing we can do overnight that's going to change the situation. It's going to take years. That's why when we talk about standards, we're talking about things we can do by the year 2050. There's a goal by many people to be net zero in terms of emissions by 2050, but that's going to take some time to get there.
Lisa, the Secretary Blinken, speaking with Joe over at MSNBC, no evidence of a Russia pullback.
Yeah, and I know that John Kerry did want to talk about the climate change issues. He was, though, a former Secretary of State, and Tony Blinken was his disciple, which leads us to really understand perhaps some of the framework as to how they have grappled with the situation. David, to the degree that we've gotten some rhetoric out of Tony Blinken really giving a threat that if this region of Ukraine gets recognized as independent by Russia, that's a game changer and necessitates a response. How do you think about that in terms of gaming out the potential for an escalation or de-escalation?
I think this is reminiscent of what George Herbert Walker Bush did in the Kuwait War. He got a coalition together, put together very effectively by Jim Baker, his Secretary of State. And in the end, the Allies were so strong that there was no chance really for Saddam Hussein to prevail in Kuwait. Right now, the Allies are so united that I don't think there's any chance that Putin can move forward and not realize there's going to be a big, big problem for him. So at this point, my view is he's looking for a way out, a graceful way out.
Right.
And diplomacy now should focus on 2 things. How can we give him a graceful way out? And how can we not brag about what happened? We want to do what George Herbert Walker Bush did after the Berlin Wall fell. He didn't go over and trumpet what he done.
Right, right.
He was very... That's what you need to do here with Putin.
David Rubenstein, my father told me they hid the newspapers from me during the Cuban Missile Crisis. Dean Rusk and the team there, off of the crisis, had to allow Khrushchev to save face. What did we learn then that we can apply now?
Well, we did give him a way out because we actually gave him something. We gave him missiles in Turkey. We said we'd pull them out, and we didn't really need those missiles anyway, so it was a face-saving way for him. We didn't brag about it in the way that I think we have to prevail. We have to do it in the future as well. We shouldn't be saying to people, we just beat Putin, we beat him, we trumpeted. We don't want to do that. What you really want to do is to say, look, we have an agreement now, it's good, and both sides won. That's what he needs to really do as President of the United States, and I think that's what Joe Biden is doing.
From an executive perspective, David, and as the co-founder of Carlyle, I wonder what your experience has been with these rising geopolitical tensions in terms of how to prepare for possible sanctions, how to prepare for a shift in the regulatory landscape.
Well, no one can really prepare completely for these kind of things because sometimes the regulatory landscape changes so quickly. In the private equity world, you tend to be a longer-term investor. But there's no doubt that firms like ours do have shorter-term investments, and we have publicly traded securities as well. There's no perfect way to do it. But any time you do a long-term investment or a short-term investment, you now increasingly look at geopolitical risks in the United States as well as abroad. And this particular risk is one that people are taking a strong look at. Now, we recognize that it's likely that energy prices will go up if Putin were to invade, and the markets have reflected that. But energy prices should come down if, in fact, we can come up with a peaceful resolution of this.
The news flow today has been dramatic, and I do want to bring you this headline that the Wall Street Journal is reporting that the Justice Department is pursuing a wide-ranging probe of short sellers, including with Carson Block, a prominent short seller who received a subpoena, had an FBI search warrant. From your perspective, David, with your legal prowess, what's your view on some of the regulatory crackdown that we're seeing right now from this administration?
I wouldn't use the word crackdown. I would say the chairman of the SEC, Gary Gensler, thinks there should be more disclosure of hedge fund fees and private equity fees, and no doubt there'll be comments about that, and something will move forward. But I think it's important that everybody who invests in these kind of funds does have very good information, and fees should be disclosed, and I don't think anybody's against that. The devil is in the details, but I think it can be worked out to everybody's satisfaction.
Let me bring it back to your conversation with Secretary Kerry. Here's a guy who's devoted years and years of public service. Now he's dealing with something that appears from all intents intractable as well. What's the Kerry agenda to get something done in the coming quarters and years?
Well, John Kerry is somebody who's 78 years old. He's not somebody who is at the beginning of his career. Why, at this age, does he want to go back and work on this issue? It's because he really seriously cares about it and thinks he can make a difference. Everybody wants to have a legacy when they're in public policy, and he thinks his legacy will probably be something related to climate change if he can get some agreements here that more than we've already had.
I'm running out of time, but what can you, with all of your advantages and your firm Carlyle, do to assist in water or the broader scope and scale of drought management? Do you have meetings on that at Carlyle?
We have a large ESG program, which means environmental, social, and governance. And so all of the companies we look at, as do other companies in our industry, we care very much about this. And 30 years ago in our business, we didn't care about ESG very much. Now everybody cares about that. And so when we buy a company, we're very certain to make clear we want to care about the environmental policies of that company going forward. We try to do things that will make the environmental practices much better than they were before.
It's going to be interesting. David Rubenstein, thank you so much. Of course,
Thank you.
Peer-to-peer conversations with John Kerry. Look for that tonight. Peer-to-peer conversations, 9 p.m. Eastern Time. The news flow is so busy, Lisa, on the terminal dealing with David here. I barely kept up with the headlines of the last 2 minutes.
I will just say that the biggest takeaway this morning was, on the surface, it looked like retail sales came in hotter than expected. As people parsed through and adjusted for inflation, it looked very different, and you're actually seeing yields come in, which I think is a pretty interesting development, considering the headline read.
Please stay with Bloomberg through the morning on Bloomberg Radio and Bloomberg Television. Extraordinary news flow, and particularly Maria Tadeo in Brussels. Good morning.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City this morning, good morning, good morning. Line it up. CPI hot, PPI hot, retail sales, the Fed's ready to go. Futures down 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, a bright green light for the Fed.
What's the Fed going to do from here?
The number one issue in the country is inflation.
The Fed is being dictated by inflation.
Are they intent on dealing with that?
As far as the Fed moving 7 times,
whether or not the Fed goes 50 in March,
they're only going to do it if the market allows them to.
Remember the dual mandates of the Fed.
Lower unemployment and lower inflation.
That's the wife and kids.
That dual mandate.
Investors are kind of more the side piece.
So what is the policy that the Fed's trying to do here?
There are still questions.
They seem to want to find one that's going to make inflation come down, the stock market go up, and everybody's happy.
They have to regain control of the policy.
All options are on the table.
Unfortunately, they got to pick one.
Joining us now to discuss JP Morgan's Bob Michael, Morgan Stanley's Matt Hornback, and SocGen's Subhadra Rajappa. Subhadra, let's start with you. CPI, let's go. PPI, let's move. Retail sales okay. How bright is that green light for the Federal Reserve?
Pretty bright at this point, given the fact that I think there was some concern, at least from me, that there might be a slowdown in growth in the first quarter because of, the Omicron variant, weaker retail sales, perhaps, weaker consumer spending, weaker services sector. But that doesn't seem to be really being borne out in the data. Thus far, the data, both manufacturing as well as the services side of the services sector, seem to be holding up okay, given the fact that we've seen a pretty decent surge in the Omicron variant. So it's mostly green light for the Fed. The question really becomes one of whether they, raise rates by 25 basis points on a measured pace for the remainder of the year, or they kind of switch to a much more aggressive stance and start raising rates by 50 basis points, either the March meeting or one of the subsequent meetings.
Bob Michael, you think this Fed has got some catching up to do?
Yeah, I think they do, and I'll confess, I never liked the idea of a 50 basis point rate hike, We look back over the last 30-plus years, there have only been a couple times they did it. In 99, 2000, they raised rates 6 times into the dot-com bubble. The last one was 50. In 94 to 95, they raised rates 7 times. The last 4 were mostly 50, but they threw in a 75. So I've always viewed a 50 basis point rate hike as serving the market a knuckle sandwich, and that's about what we're going to get.
You think we're going to get a knuckle sandwich middle of March? Bob Michael, you're looking for 50 basis points.
Yeah, and you know what? If they don't do it, they're going to disappoint us and everyone else in the market, and it's going to unanchor a lot of things across markets.
Well, initially, some people might say, who cares if we're disappointed by it, Bob? What do you think the complications, the consequences will be?
Well, I think the consequences of not doing 50 are a steepening of the yield curve. I think that any thought that you could invest in risk on through credit or equities, that goes out the window because the market will lose confidence in the Fed, that they're too far behind the curve. And look, so far this year, the Fed has admitted they are way behind the curve. Inflation is much hotter than they thought. They have a lot of catching up to do, and that starts with a 50 basis point rate hike in March.
Wow, Matt Hornback, I'll use Bob Michael's words. Do you expect a knuckle sandwich next month?
I expect this year to give us ice cream sandwiches, John, and it's ultimately because the markets are pricing in just over 40 basis points for March. And the equity market, of course, knows that, and the equity market has been okay, right? We're a handful of percentage points off the all-time high, and we're dealing with geopolitical risk as well infused into that price. So I think the markets are prepared for a 50. I agree with Bob. I think if they deliver less than what the markets are hinting at in their price, then that will amount to an easing of monetary policy. And this is not the environment to be easing monetary policy, clearly. The other observation I would make here, John, is the type of economic data volatility that we're seeing today is more reminiscent of what we see during recessions, not recoveries. So the Fed really needs to get a handle on what's happening in the economy. They need to hike 50 basis points, I think, in March.
Wow, that's the call from Morgan Stanley now. A move that big in the middle of March. Mike McKee, you've got to break down the data for us. Retail sales looked pretty good at first look.
Yeah, absolutely. I'd like to be with Matt Hornback, but the data say go with Bob Michael. We saw a huge rise in retail sales in the month of January after a revision lower in December. We were up by 3.8% on a headline basis for retail sales overall. The retail control group, which goes into GDP, basically up 4.8% after a 4% drop in December. And we missed this a little earlier, but you had a 2% rise in import prices after they had fallen in December. So the inflation and strong growth theory is still alive. You can see that in the number of sales in terms of the internet. Non-store retailers really jumping during the month. The only odd thing was that gasoline sales, and these are measured in dollars, down in January. All of this may be due to some seasonal factors, but it does show strength in the economy, which raises the question about what the Fed is going to do. And I think you've got to say at this point, the market is pricing in 50 basis points and would be disappointed, as Bob was saying, if the Fed didn't get there. Now, this afternoon, we may get some additional evidence along those lines because we get those Fed minutes. Remember the last time the Fed scared the markets by how concerned they were about inflation. This time, we'll see what their inflation assessment is. And then the all-important question, were they ready at that point to even consider a 50 basis point move? We'll also be looking for details on how and when they might start reducing the balance sheet. But the inflation growth and Fed rate rise increase is the big topics for 2 o'clock.
Mike McKee, thank you, sir. Mike's right to mention what happened last time around. We had the December Fed meeting. The Nasdaq was up on the day off the back of it. We had the minutes for the same meeting, largely repeating what the chairman had said in the news conference, and Nasdaq was down, and down hard. The 50 basis point conversation, will it be in the minutes? Citi's Andrew Hollenhorst looking for that. He's looking for a 50 basis point move in the middle of March. He says this: if there was some discussion of 50 basis points, we may get a very oblique reference to it in the minutes. You might get a statement of the pros and cons. That keeps it alive for the March meeting. So, Badger, I want to come to you on one, this idea of 50 basis points that Matt Hornback and Bob Michael essentially endorsed, and two, this idea that Matt mentioned that if the Fed didn't, they'd effectively be easing because the market is looking for something big. And I think, Subhadra, the last thing this Fed needs to do at the moment is ease.
That's true. But that said, I don't think we've really heard from, the more dovish, governors as well as, Fed presidents that they're ready to raise rates by 50 basis points at the March meeting. Even the most dovish, I should say hawkish, regional Fed presidents have said that they favor maybe 3 to 4 hikes for this year. I would say, with the exception of Bullard, pretty much the entire committee hasn't really committed to 50 basis points or even more than 3 to 4 basis with 3 or 4 hikes for this year. So in that sort of context, I still want to hear from some of the Fed governors as well as regional Fed presidents that they're ready to endorse a 50 basis point rate hike between now and the March meeting. And I think that would tee up for a 50 basis point rate hike. I'm still not yet convinced they're fully committed to a 50 basis point rate hike at the March meeting.
Bob Michael, let's push your view through the bond market. Subhadra disagrees with you a bit on the 50 basis point move. But given where we're priced at the front end now, given where this conversation has shifted to, Bob, from 3 hikes to 4 to 5 to 6 to 7 in your view this year, can you price much more into the front end than is already priced?
Well, I think that's a really good point, and I think we're being very careful not to be too bearish here. As you know, for pretty much the last 12 to 18 months, we've always said the Fed has to get to a 2% Fed funds rate sooner than later, a 0 real Fed funds rate. The market has moved to our way of thinking. 150 basis points are priced in this year, 50 next year. Yeah, maybe 25 to 50 will be pulled into this year, and you'll get to 2% by the end of the year. But from where we've come to, from where we started, I don't want to quibble about that last 25 to 50. So we're thinking that the curve flattens somewhere around 2.25%. That's it for now. There's a big pause. It will take time for the Fed to get to 2%, perhaps over the next 7 meetings. And the markets will look at that and they'll start to consolidate and risk assets will start to go up again. I think the shock occurred in the first 6 weeks of the year. Yeah. We had 6 months of repricing in 6 weeks.
So, Bob, you and I spoke back in January, and you sounded like a seller. You're sounding more like a buyer at the moment. Can you dip your toes in? In fact, can you move in with any conviction from where you were before without getting a real understanding of balance sheet reduction?
Absolutely. And I liken this to what happened to some of the previous Fed shocks, the taper tantrum being the most recent one. From May to June, there was a huge repricing across markets. Yields went up, credit spreads in high yield went 100 wider, and equities dropped 6%. And then you know what happened from June to June? Equities went up 26%, and high yield credit spreads came in 200 basis points. But in the next 4 months, yields on the 10-year went from 160 to 3%. So it is possible for the markets to digest, absorb, price in where the Fed is taking rates and for risk assets to do well. I wouldn't mind waiting until the March 16th FOMC meeting. I don't mind saying that because I think that could be the cathartic point. But for sure, we're expecting to do a lot of buying of risk assets in the second quarter.
We'll come back to that buying in just a moment. Matt Hornback, the final word here from you, please.
Well, John, I do think it's important to note that, Morgan Stanley economists still have a 25 basis point rate hike penciled in for March. So a 50 basis point rate hike is certainly anything but consensus here. And that's why I agree with Bob. I think you want to wait to see whether they deliver a 50 basis point rate hike in March, because if they do, that is going to have implications for how the policy path develops over the next couple of years. The bond market is just not pricing in enough positive risk premium to protect against the possibility that we do get a 50 basis point rate hike in March or at any subsequent meeting. So I'm still pretty defensive on bonds, and I certainly would want to wait until after the March FOMC meeting before buying.
We'll keep building on this. Matt Hornback's going to stick with us alongside Subhadra Chapter and Bob Michael as well. Equities have turned a little bit lower here by 0.5% on the S&P. Yields have turned a little bit lower as well. 10's down by 3 basis points to just north of 2%. Some headlines from Secretary Blinken. Let's get up to speed. Here's Taylor Riggs.
Yeah, Yeah, John, of course, we are hearing from Secretary of State Anthony Blinken being interviewed, of course, here, and really just continuing to talk about some of those concerns when it comes to Russia and trying to see if we can get some further de-escalation. We'll continue to keep you posted on all of those. We do have, as you mentioned, John, some equities moving as well when we take a look at earnings. Now, this was incredible when you get heads from Airbnb yesterday, beating estimates. I think the key headline, John, that really stood out to me, 1 in 5 nights that were booked last quarter were more than a month. 175,000 customers last quarter booked for 3 months or more. That really speaks to how we're not just doing weekend trips, but we're really staying there for longer. So really Airbnb capitalizing on that. Take a look at Kraft Heinz as well, because this really filters in from CPI to PPI to retail sales as well. Organic revenue sales growth up 3.9%. 3.8% of that is from price growth, right? Cost of the products that they're selling also rising big time as a percent of revenue, 67.8% now. Shopify is a little bit of a different story. You see there you're off about 10% or so. Gross merchandise volume, it did rise, and you are getting a beat on both the top and the bottom line. And they are saying that retail sales growth online can continue to grow despite sort of the reopening as restrictions lift, but they are seeing a little bit of a slowdown in the first quarter of 2022 relative to where we were a year ago.
Taylor, thank you. We got lucky this morning. You're with us for the whole hour.
I am. I don't know if you're lucky, but I'm here.
It's like a throwback, Taylor Riggs, to another time. Taylor Riggs, thank you very much. It's good to have you with us through the hour on Bloomberg TV. Some comments from Secretary Blinken on a US broadcaster, MSNBC, in the previous hour. There's what Russia says and what Russia does, and we haven't seen any pullback of its forces. Quote, so far, we haven't seen it. Coming up, the US refusing to give the all clear.
The United States is prepared no matter what happens. We are ready with diplomacy, and we are ready to respond decisively to Russian attack on Ukraine, which is still very much a possibility.
That's next. This is Bloomberg.
Variant and the latest wave have an impact on not only consumer trends but your business, and do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida, and I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Season continues.
To the Metaverse, to Spotify, to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's a tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
So far, we have not seen any de-escalation on the ground. On the contrary, it appears that Russia continues the military buildup. We are ready to sit down and discuss with them, but at the same time, we are prepared for the worst.
Western leaders on guard. The Defense Ministry in Moscow saying the following: units of the Western and Southern military districts that have completed their missions and will start moving back to their garrisons today. The Kremlin has also denied the claim that it's continuing a military build-up in the area. Joining us now is Bloomberg's Anne-Marie down in D.C. Maria Tadeo out of Brussels and NATO's headquarters. Maria, what is the latest?
Well, Jonathan, I've been at NATO the whole morning because European defense ministers, you know, are holding a meeting today. Of course, a lot of this in reaction to Russia. And what I hear at this point is that they do not see real proof of de-escalation. They continue to say that they want to independently verify the claims that Russia is making about pulling the troops back. They also say that this is not just troops. They need to pull back some of the weapons and the military equipment that could be left behind and put them again in a position to attack Ukraine. And they also say that they want their own intel to essentially confirm all of this. The flip side, of course, is coming from Russia. A spokesman for the Russian government saying today marks the biggest propaganda effort that we've seen from the West, with an invasion that did not take place and that was essentially fake.
AMH, just moments ago, Secretary Blinken with MSNBC, the US broadcaster, saying there's what Russia says and what Russia does, and we haven't seen any pullback of its forces.
Yeah, he basically reiterated exactly what we heard from Ukraine's foreign minister yesterday, the second we had that news of reporting out of the Russian Defense Ministry that they had planned and were moving troops back. And to go a little bit further, Secretary of State Tony Blinken also talked about the fact that not only are they not seeing Russia pull the troops back, but they're actually seeing an effort to move some forward. And they want to engage with the Kremlin, but they are prepared for either direction, whether or not this goes towards more escalation on the border, or whether or not it goes towards a path of diplomacy, and they actually see that troop movement move away from the border.
AMH down in D.C. Anne-Marie will catch up a little bit later on those Fed picks as well. Maria over in Brussels, thank you very much. Let's turn back to the panel. Bob is with us alongside Matt and Subhadra. Bob, let's start with you, sir. The energy piece of this and fixed income at the moment associated with this broader story. Bob, how are you and the team thinking about it?
Well, of course we're concerned, because any incursions into the Ukraine, you're looking at oil going up. Pick your multiple of 10, 30, 40, 50%. That's a big shock. We step back and we think about that and we wonder, how will companies be able to pass that along? That's the first problem for corporate profitability. And then it also brings back into play some of Bullard's comments, get to 1% by July. So there's a little bit of protection against an oil price spike in that 1% number by July, we believe. So we think he's right. The rest of the FOMC, who thinks they could do 25 basis points a couple times this year, are wrong. And here's another ingredient that has to go into their calculus.
Subhadra, your response, please.
So I think there is a level of complacency, if you will, in the markets. You're not seeing that level of panic either in equities or in the commodities complex, or even in bonds for that instance. I mean, we saw a little bit of a flight to quality on Friday after comments from the White House, but broadly speaking, the market seems to be dismissing any sort of serious escalation, if you will, coming from the Russia-Ukraine conflict. So really, for the most part, I think that there's we just have to see real action before you start seeing panic. What the situation is doing right now is contributing to the volatility in equities as well as fixed income markets, broadly speaking. But again, I think all bets are off if there's actually action, because you're going to see a significant repricing both in the bonds as well as in the stock markets and in the commodity complex, which is going to be very, very negative for the economy. And that's why I think another reason why the Fed's going to be very, very careful heading into March and not jumping into a 50 basis point rate hike.
Well, crude's already in the 90s, just short of 95 on Brent at 94.89, 93.49 on WTI. Matt Hornback, this takes us quite nicely to the work that you and the team at Morgan Stanley have been doing. I think of Mike Wilson's work over the weekend as well. It starts with an inflation story, then a rate response, then a growth scare. You're on point 3, Matt Hornback, already.
Yeah, well, I mean, John, I think the growth scare part of that 3-part series you just mentioned is really where the debate is today, at least in my conversations with investors. You know, people are wondering what the flattening of the yield curve is actually suggesting about the future of economic activity in the U.S. and abroad. And so, you know, when we look at the flattening of the yield curve, you know, our read of it, and much to the point that Subhadra raised on the lack of reaction, more or less, in financial markets to what's happening between Russia and Ukraine, is really a liquidity effect, we think. I mean, we have to remember that both the ECB and the Fed are still easing monetary policy, if you can believe it, with their bond purchases. And I think ultimately that source of liquidity, albeit it's much less today than it was last year, is still making its way into financial markets and ultimately cushioning the blow from some of these geopolitical events that we're monitoring.
Look, Matt, it's a good point. Every time we have this conversation, I laugh. Every time someone reminds us of it, they're still doing QE. It's not over yet. Bob Michael, Matt Hornback, Subhadra Rajappa sticking with us, staying on top of the diplomacy, the headlines coming from respective leaders at the moment. A little bit later, President Biden to speak with his German counterpart, Chancellor Scholz. That will happen today, according to a US official. Another one for the diary. Coming up next, the morning calls, and later, the worst inflation in a decade. Heineken boosting its prices to offset surging input costs, and worried people might drink less beer. Really? That conversation's still ahead. From New York, this is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Here's the situation, whipsawed by headlines. The Russian government suggesting they're pulling back. The US government would like to see some verification of that. And in the meantime, we just knock it around in between headlines from either side of the Atlantic. Futures down 0.5% on the S&P. The bond market shaping up as follows. 2s, 10s and 30s, equities down, yields back in. A few basis points, down by 2 or 3 on 10s to about 2.02%. That's the price action here in the morning calls. First up, Wolf Research naming Raytheon a top pick in the aerospace sector, highlighting its underappreciated and improving free cash flow. A stock is unchanged. Bank of America downgrading Viacom CBS to neutral, no longer expecting an imminent takeover following its quarterly results. And finally, Evercore upgrading Macy's to outperform $50 price target, seeing several catalysts potentially boosting shares up by 90%. We're at $26.55 in a pre-market, up by 4.4% in early trading. Up next, Heineken sounding the alarm on surging inflation with Walmart earnings on deck. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This market and the sentiment around it is driven by headlines. It's not the kind of market you like. And those headlines are coming out of Ukraine, out of Russia, out of Germany, out of the United States. Chancellor Scholz and President Biden will be speaking a little bit later. Futures are down 0.5% going into the opening bell. There is your opening bell. Switch to the board and get to the bond market. CPI last week was hot. The PPI was hot. Retail sales were good. Yields north of 2% on 10s coming back in just a little bit. Your next stop here, Fed minutes later this afternoon, and $19 billion of 20-year notes coming to market. Euro dollar unchanged at 113.57. Crude just about positive, up by 1.5%. 93.50, let's call it, on WTI. So 20 seconds in, your equity market is lower by 1/3%. Bottom of the pile here, communication services down 0.6%. At the top, given where crude is right now, energy equities back on top, advancing by 0.7%. Breaking this one down for you with your movers at the opening bell. Here's Taylor Riggs.
John, it's interesting that you mentioned technology sort of at the bottom of the screen today, and maybe for the year in many cases. There's some interesting movers as it comes to this space as well. Remember when Apple made all of those privacy changes to their iOS software on how they can track you, making it harder actually to track you across different apps? Well, it looks like now Alphabet is trying to do a similar story when it comes to their Android phones. And so really making it harder for some of the advertisers to track you, make it more personalized. When Apple did that, remember, it wiped out about $300 billion from Meta. We know that is Facebook, their market cap. Just your daily reminder, with that stock off 3% today, you're still off 40% from your record high and off 30% from the last earnings. So really all trying to digest what some of these changes within the social media space mean for some of these companies as well. Flip up the board because we're also in the middle of earnings. So let's take a look at this. Akamai is an interesting one. Now, they kind of have a relation to the streaming service, but investors really digesting the purchase of Linode and trying to look at it as a long-term positive, despite maybe some uncertainty this morning. We talked about Viacom. The streaming numbers look good, but remember, it costs a lot to continue to remain in that space. Airbnb was a huge standout, as I think I said at the top of the hour. 175 customers last quarter booked nights for more than 3 months or more. So, John, we may be the only ones not away for 3 months. We're actually still here in the office. And finally, Kraft Holdings. It is all about that price pressure and passing those costs on to the consumer.
Did you see Belgium might be going to a 4-day week, if you'd like one? Did you see that news?
We could move there.
4-day week. I said I'd take surveillance to Brussels. We'll do the show out of there. And, Taylor, you can turn your work device off without fear of reprisal. Apparently, you can ignore the emails. We're all going to Brussels. Taylor Riggs, thank you very much. This show gets serious now on the inflation front. Beer is about to get more expensive. This was the Heineken CEO.
The big unknown is, how much of pricing are we able to pass through? We already took 8.3% pricing last year, 11% in the second half. That's about the highest pricing that we have seen in a generation. We're a bit cautious in our outlook, is that we don't know for how long that will last, as what's happening right now is rather unprecedented.
Kelly Lyons, will consumers push back?
Well, that is exactly the question. Inflation is front and center, not just for companies like Heineken, but for consumers as well, and of course, for central banks. And just to put in perspective the kind of inflation we are talking about, it is the highest in decades, 9.7% on producer prices, 7.5% on consumers. That is the reality at the moment. And the interesting thing, John, is we've seen this showing up in consumer sentiment. It has been diving as inflation has hit them everywhere from the grocery store to the gas pump, but that hasn't actually materially translated into any spending pullback as of yet. We saw that borne out with the retail sales data we got this morning, blowing estimates out of the water, showing demand is still resilient in the face of inflation. The question is how long that's going to last, if consumers will continue to tolerate these higher prices as real wage growth is lagging and they're starting to draw down on their pandemic savings. And this is really what the Heineken CEO was alluding to. It's an issue for retailers as well, as they try to exercise pricing power in order to protect their profit margins with some of the higher costs that they are facing, but without doing a material hit to the top line as a result. That is especially true for discount retailers that cater to lower end consumers like Walmart, which will be reporting tomorrow. And we'll get more retail reports from Home Depot, TJX, Lowe's over the course of the next week. Those cost pressures will be front and center, John.
Kelly Lyons, thank you very much. Bob Michael, can I just come over to you? Could you do a quick study on the price elasticity of demand for beer? What would your thoughts, just lean on your economic knowledge, what do you think that would be?
You moan about it for a few weeks and then you pay for it. And I think Kelly made a very important point about how resilient the consumer is. It bounced back from bad spending in December with strong spending in January. The consumer looks great. That's 2/3 of the economy. We have to accept that. You look at deposit balances, they are still very high. Sure, they've come down a little bit. They are still very high. And wages are going up at rates we haven't seen in decades. And in a tight labor market, guess what? Heineken is going to raise its prices, and then it's going to have to pay its workers more, first to find workers, and then they're going to demand higher wages so they could pay for the higher prices of the beer.
On the US consumer, I'll take that last remark seriously. RBC's Amy Wu Silverman said this.
Like an Ollie or a dollar store, Dollar Tree, Dollar General, the Walmart, Yum, all these cohorts where it's very leveraged, that low-end consumer. We're not seeing that start to be priced in, but now the options market is starting to flag that concern to the downside.
Sabatra, are you expecting some pushback from the consumer this time around?
It's possible, right? But the counterbalance to the consumer trying to push back on this is that the employment picture is pretty robust. You're looking at an economy that's at or close to full employment, with investors have a decent amount of disposable income in the background. They also have a decent amount of savings. So I think that this, it's going to prices have to remain higher for a lot longer for us to see that really meaningfully impact the consumer. You're seeing that in the January retail sales data where, investors, money that they didn't spend perhaps in December because of the Omicron variant, they're spending in January in online as opposed to in-store, purchases. So there's money to be spent, and I think you're going to see that at least for the first half of the year, which is kind of supportive in some respects for policy. So that sort of trajectory, I think, is here to stay. We'll have to see if that persists, because real earnings are coming under pressure, and over time, I think the consumers are going to have to pull back.
If you're just tuning in, we're about 6 minutes into the session. We're pulling back on 10-year Treasury yields by 2 basis points, still north of 2%. Not a major move. One more stop for this bond market. At about 1 p.m. Eastern, we get an issue of $19 billion worth of 20-year notes, then the Fed minutes. If we take a look at the equity market, we're pulling back just a subtle amount, a mild move lower. No drama here in a big way. Just some comments from Secretary Blinken in the last hour saying the following, quote, There's what Russia says and what Russia does, and we haven't seen any pullback of its forces. So far, quote, we haven't seen it. That back and forth just continues. That echoes what we heard from the president yesterday and what we've heard repeatedly now twice in the last 24 hours from the NATO Secretary General Jens Stoltenberg. So equity's just a little bit lower, softer on that. The story from Mike Wilson of Morgan Stanley is this. Let me quote him. It's time to pivot to growth and how much it will decelerate. We remain more concerned about growth than most, and Friday's consumer confidence number should not be overlooked in that regard. Correction remains incomplete. Now, Matt Hornback, you work closely with Mike, so let's build on this together. What are your thoughts on this issue with the consumer, and why is this belief that risk assets haven't seen that correction that some people think we have?
Well, John, I mean, I think within any research organization worth its salt, there's healthy debate about these various issues, and in our organization, that applies. I mean, our sense of it is that growth is set to accelerate from here. I mean, that's what our economists are calling for. That's the way I'm looking at the economy. I mean, with respect to this idea that consumers are feeling badly about paying higher prices, I mean, who wouldn't be feeling badly about paying higher prices? The question is, are you willing to pay those higher prices? And we see very clearly that people are willing to pay them. Now, if people don't feel like they can afford to pay those higher prices, there are plenty of options for them, right? They can demand higher wages, which is something that we're seeing. If they're not working, they can go out and fill one of the 3 million more job openings that we have today than existed before the pandemic. So if you're really upset about paying higher prices for beer, which I can appreciate most people would be, go out and get a job, or you can actually demand higher wages. This is the environment for you to do that. And that's what we're seeing. So we think growth is going to be pretty healthy this year, John.
Matt, the issue, though, as you know, is not as simple as going out and getting a job. Wage growth in real terms is negative. Isn't that the issue at play here at the moment, Matt?
Well, John, look, when the money hits my bank account, it hits in nominal dollars. It doesn't hit in real dollars. And it's ultimately my decision as to whether I take those nominal dollars and go pay nominal prices. And again, this is what we're seeing. We're seeing people going out and paying higher nominal prices. And that is in part a factor behind what's driving inflation higher, is the demand side of it. And again, like I said, our economists expect a very robust real economy this year. We've got real growth upwards of 4%. We're not that far away from consensus either. So consensus also expects very strong real economic activity this year. And as we see that come through, you know, this is what the Fed is going to have to increasingly focus on.
Matt Hornback, you know me well. I'd never look to expose internal divisions of a research department, ever. But Michael, your view on why this correction is incomplete?
Could I just add one thing to Matt's comments? If you can't afford it as a consumer, what do? You finance it. And this is where the Fed has to enter the fray, because inflation is pushing up the cost of goods and services everywhere. You're seeing it in housing prices, but guess what? Consumers will pay higher housing prices because the cost of mortgage financing is still at generational lows. It's the weekend, you want your beer, it's going to cost more, you don't have a lot of cash, put it on your credit card and figure out how to pay it back later. Those credit card costs are also low. So I think that's one of the things we need to talk about. Why the Fed is coming in and raising rates is because the cost of financing these higher prices is not prohibitive. Now, well, what did you want to talk about?
I wanted to talk about a market correction, but you brought up something more interesting. This rebound, this recovery we've seen, Bob, wasn't really fueled by consumer debt, household debt. It was fueled by fiscal policy. And I just wonder, Bob, how you think this market, how consumers, how the economy will respond to higher interest rates this time around with that in mind.
Really? I don't know who goes out and buys a house with cash, particularly with the price appreciation we've seen.
Well, Bob, let's talk about consumer spending.
Look at the retail.
You saw the savings rate.
Look at retail
you knew
sales.
Where savings were.
Furniture was a big item. A lot of that gets financed with credit card. So there's a lot of financing that occurs. You're right. There was a huge fiscal impulse, and that fiscal impulse created higher savings, and that's trickling down a bit. But that's maybe it's giving the consumer conviction to keep spending. And then Matt's right. They're watching the deposits from wages into their account go up. They're not thinking of it in real terms. They're thinking of it in absolute terms. And we think that continues for the next couple of years.
Subhadra, final word, please.
Yeah, no, absolutely. I think that there's definitely a lot more room for for growth of the consumer. There's definitely I think growth is going to be pretty robust for this year, and for the most part, I think that this sort of trajectory towards higher yields is very much in play. We'll just have to see how the data progresses and if the Fed will actually be able to raise rates at the same pace at which the market's pricing in.
You see what happens when you mention the price of beer, Subhadra, how fired up the gentlemen get every single time. How spicy these kind of segments get, how quickly they do. Subhadra, thank you. Subhadra Rajappa, to Matt Hornback and to Bob Michael. We're not trying to fall out here. Everybody's friends. It's good to catch up with you both. Thank you very much. About 12, 13 minutes into the session. Your equity market's pulling back just a little bit. Coming up, we head down to D.C. on something we haven't talked about so far. The president's Fed nominees hanging in limbo.
Sarah Bloom Raskin has spent recent years pressuring the Fed to stop being a neutral regulator and instead become an ideological left-wing activist body.
That's next. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I will delay
votes on these nominees. We will update you when we've rescheduled. My Republican colleagues claim it's because they haven't gotten the information they've requested from one of the nominees. Let me be clear, Ms. Bloom-Raskin has been the subject of an unrelenting smear campaign and fear-mongering by the ranking member and Republicans, something that's become all too common.
This is where things are at right now in Washington. Republicans stalling votes on President Biden's Fed picks over just one nominee. The GOP Senator Bill Hagerty demanding more answers from Sarah Bloom-Raskin.
There are more than 35 questions where her answers provided were blanket, I do not recall or I'm not aware, in response to questions on this. So we have not gotten to the bottom of this, and we need more information. And until we do, I'm not prepared to vote on her.
Let's head back down to D.C. and catch up with Anne-Marie. Hey, Anne-Marie.
Hey, John, as you could see there, just given the rhetoric from the Republicans and from Sherrod Brown, the Senate chair of the Banking Committee, this is becoming very contentious. And we should point out that the timeline now is very elusive because now you not only have an issue with Sarah Bloom-Raskin, but given the fact that Republicans do not want to push ahead on her vote, and the Democrats are saying they are all going to be lumped together, all 5 of the president's Fed nominations are right now in limbo, and the Senate is going to go on recess starting Friday afternoon. So what you have now is potentially no movement forward on the president's Fed picks, and all 5 of them, including Fed Chair Jay Powell, being held up in this.
AMH, the latest in Washington. I imagine we'll get more details on this through the day. So some tension in Washington on a particular issue that's important. Some more tension with China and Hong Kong. This came from the chief executive of Hong Kong, Carrie Lam, saying the following. At this critical moment, we must give full play to the advantages of one country, two systems. I have submitted a report to the central government and put forward specific requests for assistance as soon as possible. Mike McKee, you'll read on what's happening right now with the leader of Hong Kong and the leader of China, the Chinese President Xi Jinping.
Well, they're cracking down because they're worried about the outbreak of COVID in their countries. It's all one country, according to the Chinese. But here's the thing, John. The virus is still in charge everywhere. The interesting news of the day, along with China, is that in Europe, as you can see, cases are starting to decline, but they're nowhere near down as much as in the United States, and yet the Europeans are loosening restrictions much more quickly than we are. In Germany, Austria, France, Switzerland, the Netherlands, announcements coming that they are starting to get rid of the restrictions on people's ability to go out. China, of course, is still stuck with rising caseloads, so they're going through this, we must do everything possible because they have their no COVID policy. So that leaves the question, what happens here in the United States? Next week, the Center for Disease Control is expected to reduce its mask mandate, make a change to that so we need to wear them as much. But we're still waiting to see how that plays out. The one bit of interesting good news for Americans who want to go on vacation, Disney is dropping its mask mandate as of the end of this week. Beginning February 17th, face coverings will be optional for fully vaccinated guests in both outdoor and indoor locations. It's all a reminder that no matter what happens, we still have to keep an eye on the virus.
Have you seen this quote from Xi Jinping? Just to go back to that, Mike, I just want to read that out for our audience. The Chinese president is saying the following. Hong Kong's government must take up the main responsibility to stabilize and control the pandemic as soon as possible as a mission that overrides everything. Mobilize all available forces and resources and take all necessary measures to ensure the safety and health of Hong Kong's citizens and the stability of Hong Kong's society. Mike, you've covered this stuff for a long time. Have you seen the Chinese president take such a strong line to speak so forcefully about what's happening in Hong Kong?
Well, not necessarily about what's happening in Hong Kong, although when they were going through a lot of the civil disobedience, Xi Jinping was very strong on cracking down on that. It's the COVID-0 policy. His policy is there should be no COVID in China, and you isolate people and you lock down until you get rid of any outbreaks. And Hong Kong hasn't done that yet. Much of the rest of the country has. It's slowed the economy, and he's worried that we're going to see some real problems with Hong Kong, given its role as a financial center, as an export center, if they don't eliminate COVID from there.
Mike, got to run in a minute. Just a final word. Caught up with AMH just then, down in Washington. What was happening with the Fed picks? How do you think this plays out?
Well, it's going to be up to the Democrats' leadership to decide whether they want to take the steps that they do have available to them to pull the nomination from the banking committee and take it to the floor directly. It's complicated, but they can do it. All of that has to wait on the New Mexico Senator Ben Ray Lujan, who had a stroke, coming back to the Senate because they would need every vote to do it.
Michael McKee on the latest. Thank you, sir. Let's get you some sector price action on this equity market as we pull back just a bit. Here's Kriti Gupta.
Well, good morning, John. Red on the screen, a lot of it has to do with tech driving the indexes lower. A lot of that selling pressure concentrated in that big tech sector. Put this into perspective, though. Yesterday, you saw the NASDAQ rally 2.5%, so perhaps a reaction to simply the gains we saw yesterday. To the top side, though, you are seeing energy outperform up 2%. A lot of this has to do with, of course, falling oil prices, really tracking the uncertainty between those Russian and Ukrainian tensions. Let's get back to the tech story, though, because that's really where you're seeing a lot of action, not just big tech, but specifically in social media names. This comes after Google is planning to adopt new privacy restrictions that curtails tracking across apps on Android smartphones. It's a move that follows what Apple did not long ago and puts limits on companies that get a lot of their revenue from tracking the advertising spending, John.
Kriti, thank you very much. Kriti Gupta on the latest price action. Coming up, your trading diary from New York City. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
"25 minutes in, equities pulling back here by 0.7% on the S&P. On the NASDAQ, by a similar amount. We're off by more than 1% now, down by 1.4 on the NASDAQ 100. The data's been decent. CPI last week, massive upside surprise. PPI, upside surprise. Retail sales, upside surprise. When I say decent, I mean decent for those calling for a big move from the Federal Reserve. The likes of Matt Hornback, Bob Michael talking up a 50 basis point move from this Fed in the middle of March next month. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. Yields come in as equities start to dissolve a little bit lower as well. We're down by 3 basis points on 2s, just short of 155 on 10s at 2.0259%, down 2 basis points as we continue to get whipsawed by headlines out of Ukraine, Russia and the United States. A conversation a little bit later between Chancellor Scholz and President Biden. That's set to take place today. We'll bring you the headlines as they come through. As the price action, here's the trading diary. Minneapolis Fed President Neil Kashkari speaking at 11 a.m. Eastern Time. Then the U.S. Treasury selling $19 billion in 20-year bonds at 1 p.m. We'll get the Fed minutes at 2 p.m. plus President Biden meeting with Germany's Olaf Scholz. Initial jobless claims coming up on Thursday and more Fed speak. Mester, Evans and Williams all on the docket. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
You find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat.